It would seem. Heineken, we're also focused on that business. They put out some numbers this morning, and beer volumes shrinking. Late Easter hitting demand is the story there. We're also keeping an eye on what's going on in aviation. United Airlines providing two possible earnings scenarios, expecting, of course, some kind of hit if the US economy is going to go into recession. And so that could be something we see from a number of businesses, that kind of option on scenarios ahead.
Absolutely, and Scott Kirby's going to join us a little bit later on to discuss. Okay, here we go. Time for the market open this Wednesday morning. We're going to keep a firm eye on what is happening with the Amsterdam market. We put that in for you today. We are going to watch ASML very carefully, the epicenter of the chip action here in Europe today. The FTSE 100, as Critty's been indicating, actually not falling very much at the moment. We're down by 0.2%, 1/10 of 1%. A much flatter appearance from the FTSE this morning than we're going to see potentially elsewhere. So the Stock 600 down by 0.3% of 1%. The IBEX is down 3/4 of 1%, but the main events have yet to happen. We're going to wait for the CAC. There it is, down 0.8 of 1%. We'll see how some of the chip stocks fare within that, but we're really waiting to see what the AEX does with ASML, and some of the chip stocks out of Germany as well could be affected. It could take a little while to get those markets up and running this morning, Critty. What are you seeing below the surface?
Well, a defensive bid surely in the market, and I'm just waiting to see if we're going to get some pricing on ASML this morning. It doesn't seem to be just yet a trading halt there. So some of the kind of plumbing, the market's still working through. But you can see it right off the bat. Utilities are your outperformer. If you're looking at the FTSE 100, National Grid showing up right at the top in terms of the index move to the upside, but pretty broad declines everywhere else. You're looking at the commodity sector taking their tune, Anna, from the likes of Brent, copper, etc. BP, Shell, Rio, Anglo, all taking a beating this morning.
Yeah, absolutely. So the fact that the FTSE is laden with defensives does play to its strengths today, but it's still down by 0.2% of 1%, but it's not down that much, given that basic resources is actually the worst performing sector today, followed by energy, Critty, and both of those heavily represented, of course, in London. But that utilities bid away from basic resources and energy does seem to be lifting some of the UK listed names as well as utilities elsewhere. There's also some strength coming through in some grocery stores and some of those consumer staples. It is that classic flight to defensives, it seems.
Heineken's actually trading stronger. Its numbers this morning seem to be going down reasonably well. I wonder if that's a safe haven bid.
I was going to say, when things go bad, you just
buy beer.
Buy beer, drink more beer. Makes sense.
We've had days where that's been the case, yes.
Yeah, a lot of them, it feels like, recently.
Just recently.
Going into a long weekend, maybe that is the right trade. It's going to be reasonably sunny. But the defence stocks are also trading higher as well. So that certainty, that visibility is maybe what the market is seeking out this morning, an understanding of where some of these stocks are going. Probably easier to understand in a name like Heineken or National Grid or Unilever than maybe like Nova's down. Joe was bringing us the downgrade there, but SAP, LVMH, Schneider, these are the kind of names that are certainly moving on the downside at the moment.
I was going to say the tech kind of read through there, even though I know we're keeping a close eye on the chip sector, but the tech read through the likes of SAP, for example, or even, ASM International as well, which is different than ASML. Of course, I always have to kind of remind myself that. Also trading down a whopping 5% at the open. We're still waiting for the actual open on ASML, but already you can see some pain, not just in the chip sector, but broadly in the broader tech sector as well. So how do you value something like that? In the famous words of Dan Ives over at Wedbush, if you trade tech on valuations, you miss out on the rally. We spoke to Kevin Gordon from Charles Schwab about how valuation analysis shows up in this environment. Take a listen to what he had to say.
I mean, the reality is the compression has been all multiple driven. It's been all multiple contraction. So a lot of people will point to the E component and say, well, forward earnings are still going up, so it's fine. I mean, you can't really rely on that metric. So if forward earnings estimates are going to continue to go up, that's actually going to put all else equal upward pressure on multiples. But of course, we know that's not necessarily the case right now. So I think it makes, similar to 2020 and 21, again, it makes valuation analysis not very helpful, if probably, just not useless at this point.
Let's bring in another voice here. Karen Nundra, head of equities over at Jupiter Asset Management, joins us around the table. You picked a great day to join us because I feel like when we're talking about a tech-driven sell-off, valuation, or the question of valuation always comes in. You heard Kevin Gordon there saying that valuation is useless at this point. But at the moment where you're seeing such a discount, arguably, on tech, do you buy?
So I think taking the point around valuations, that is absolutely really important. So I'm going to come to tech in a minute. But what we're seeing at the moment, especially when it comes to US equities, is that despite the sell-off that we've experienced, US equities are still trading at like 27.8 times kind of Schiller PE levels. And that compares to far more attractive valuation levels elsewhere. So when I'm thinking about where we're looking to invest and where we're looking to put money to work, it's definitely been in that kind of European side. But in terms of where we're positioned in the European part of the market, that is much more actually on that value and cyclical part of the market.
So, Karen, as you were speaking, we just got the opening numbers on ASML. You can see it on your screen there, down a whopping 7% on the opening trade after that first quarter bookings miss. It brings this question, though, of when you're talking about tech kind of leading this market lower and having that cyclical position, is tech no longer a defensive asset? What would you categorize that as?
Well, that's a great question. So I suppose when we came into this whole crisis, tech valuations were incredibly, incredibly high. And this means there's been less of a kind of valuation buffer. And what we saw with NVIDIA overnight has really shown, when it comes to the tariff war, how difficult it's going to be to actually move supply chains and for companies to kind of react to that, I would say. So that kind of inability to move supply chains, some of these supply chains have been put in place over decades, and that's incredibly difficult to replicate. And that's what we're seeing in the market now, that there's kind of realization that that's going to be very difficult to deal with. But I think just coming back to your point on expectations, clearly there's that growth and the earnings consensus and the earnings expectations. But what we're really seeing here right now is a mismatch between expectations and what companies are delivering. And we saw that in Q4, particularly last year, where hitherto, tech companies have been producing kind of really strong earnings. Investor expectations were rising, and companies were over-delivering. And Q4 was the first time we actually saw a balancing out of that. And I think that's made that valuation equation a lot less compelling. And this is talking about global tech valuations. Clearly, we're seeing a lot more, I would say, room for that to compress in the US.
Does predictability carry a premium at the moment? If I can predict what a company is going to do I want to own it more at this stage?
Typically, you would say that in this type of environment, those types of more stable companies are the types of companies that should be doing well. The problem that we've found, especially globally, is that those companies that have had those strong moats, that have been very predictable, those are actually the ones that have had the really, really high valuation levels, and that's what we're suffering with now. And in a rising inflationary environment, that's why we're seeing some of those more value and cyclical names start to actually outperform, because they've got that much more of a strong valuation underpin that those other stocks don't have. So I think.
Do I want to own the cyclical, potentially going into a recession?
So cyclical companies, if we think about value companies, I'm talking really about kind of value names here, and ones which are more domestically focused, those are the types of companies that we'll be looking at. So when I'm thinking about for banks, for example, in this type of an environment, actually we are very positive on banks, especially within the European space. Energy stocks are still looking pretty interesting, and that's despite, for example, oil doing what it's doing. If we look at the implied oil price in the valuations of energy companies today, we're seeing implied oil prices of $50. So typically, I would say in a normal environment, you would be wanting to go into those kind of more quality names, but given how expensive those names have been, they're more vulnerable than they would be otherwise.
How much, Kieran, how much are you taking money out of the US and putting it into Europe right now? How much of that is an overall theme? for you?
Yeah, so we're already seeing some of that moving out. So if you think about just euro-denominated funds or European funds, in 2009, those funds actually had around 15% exposure to US equities. Today, that exposure is 45%. So I think given what's going on with that lack of certainty, and we're going to get into, for example, the US dollar, but what we're seeing there, I think we are going to see a reallocation of assets away from the US and more kind of internationally diversified.
And that's just very much at the foothills of that trend, are we then? Because if Europe was so not overexposed, but in the current moment perhaps feels overexposed to the United States, there's so much more of that still to go.
Yeah. So I mean, look, to be absolutely fair, so the US has delivered up until the US has delivered since GFC, it's delivered 17% annualized returns with a 13% volatility. The Sharpe ratio of US equities has been phenomenally strong, and there is no reason really why anyone would want to look elsewhere. I think that equation is absolutely changing right now, and I don't think it doesn't require European assets in particular to start outperforming. It's just that diversification benefit of having lower correlations is just hugely beneficial for portfolios globally. So I think that's why we're going to see that move away from US and into other regions.
Yes. Are you buying into regionalization themes then, as opposed to globalization?
Yeah, absolutely.
Where do you see the best opportunity for that?
So we are definitely looking at. So Europe is definitely an area that we're looking at, and in terms of those areas within Europe, it will be banks, it would be energy, and then we're also looking on a very kind of stock by stock basis. So those companies that had done well in dealing with COVID, for example, especially when it comes to kind of nimbleness of supply chains, that's something we're absolutely looking at the moment. And then even within Asia, so moving out of Europe, we still have an underweight to China. That's very much a longer term position that we've had, notwithstanding where valuations are. That's still a position that we stick to. And I think the other thing I was going to point out is that there are certain countries which are almost too big to be small and too small to be big. And by that I mean that the Southeast Asia, I think, will have its own issues, but countries like India, for example, are still really interesting because they have their own structural growth drivers that are still very much intact, and they're just less dependent on global trade.
Great to see you. Thanks for stopping by to see us. Really appreciate it. Thank you very much. Kieran Undra, Head of Equities at Jupiter Asset Management. The Core 6 is having a fun morning. Let's take a look at some numbers and just show you what exactly is happening. You can see ASML is down, let's call it circa 6% at the moment. We've been down below 7%. LVMH is off, Novo's off. The chip space generally is under pressure this morning, but it's spreading out into more, you could argue, the data center story. Look at Schneider down by 1.3%, but actually doing reasonably well. But the right-hand side of the chart, there's your safety trade. Nestle, Staples, doing relatively well this morning. Joe Easton's got more details. Over to you.
So ASML, Guy, really the big news today in terms of the sectors moving. We are seeing losses across the chip space today. ASML, as you mentioned there, was down around 7%. It was in a trading halt initially, now down 6%. Also seeing a feed through in peers, BE Semi coming lower as well, and VAT as well. Just a couple of the other chip machinery stocks coming down. Remember the Nvidia decline as well, post-market in the US weighing on the sector, but the ASML order myth seems to be hitting the space today. Then Heineken does appear to be selling enough beer, apparently. RBC writing that actually the volumes were better than their expectations. So Heineken actually rising around 3%. Also over in Amsterdam, like ASML, of course, that one coming up around 2.6% at the moment. Rio Tinto was lower in Australia and lower in London as well. Their iron ore exports missing expectations. A bit of a weather impact, according to the report. The copper business actually doing pretty well, but that does seem to be weighing on the stock with the broader market declines as well. And then one that's even worse, one Anna mentioned earlier, Bunzl, now down almost 23%. This is a distribution company here in the UK, distributing food and outsourcing, that kind of thing. Slammed on very weak numbers, very weak guidance, and also not doing the buyback that analysts were expecting. So Bunzl, the worst performer across the entire Stock 600 today, down 24%. Now for that one. And then another one slipping over in private equity, EQT, the exit rates in the last quarter not as good as expected, according to analysts. analysts. Now, that's a $30 billion company, and it's coming down 6%, so a big move lower on EQT today. That one hit over in the investment management space. And then finally, just a touch back on Novo with that new underperformer over at Exane, only the third broker with a sell rating on the stock, a 405 target, the lowest on the street. Still got some way to come down. We're at 420. Too much competition for obesity drugs is the view from Exane, and they think the cash flow isn't good enough either. So Novo slipping with the broader market, down 1.4% in Copenhagen today.
Joe, thank you. Joe Easton. We'll dive more into the tech themes coming up. The chip story, certainly front and centre, following disappointing numbers from ASML and the escalating trade war, geopolitical concerns between the US and China, I mean, more limits on Nvidia, all of that conversation coming up next. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. 17 minutes into the session. Chips are down, definitely. Down pretty hard, to be honest. ASML under significant pressure. It's hard to separate out NVIDIA from ASML this morning, but we're going to give it a bit of a go and figure out what is going on here. Our executive editor for global technology, Peter Elstrom, joining us around the table. We'll get to NVIDIA in a moment. ASML, talk me through what they are. The concern seems to be about forward bookings. So are we starting to see the effect of a tech slowdown? Is this a tech slowdown that we're starting to see? Because in theory, it should start at ASML and kind of work its way through the supply chain.
Yeah, that's right. So ASML reported financial results that were not bad.
Yeah.
But as you alluded to, there's a real focus on their bookings. Now, bookings are kind of lumpy at ASML. Their machines can cost up to $400 billion.
Huge.
People do book them, in kind of lumps. But what we're seeing is a pretty serious slowdown. Analysts were forecasting there were going to be bookings of 4.8 billion euros. Instead, they came in at 3.9 billion euros, almost €1 billion short of what they were expecting. That's a pretty worrisome sign already. And on top of that, the executives had prepared remarks where they talked about the tariffs. The Trump administration tariffs are creating additional uncertainty in the market. They're not exactly sure how that's going to play out in terms of demand for their goods. They did keep their revenue forecast the same for this year, but they cautioned that there's a lot of uncertainty in the market right now, and it's not exactly clear what's going to happen with those chip equipment orders.
So these are many millions of dollars of chip equipment that we're talking about here. Take us on then to some of the customers for some of these machines. That takes us on to the NVIDIA conversation, perhaps. But the NVIDIA conversation overnight is actually about what they're able to send to China and the export controls that have been now put in place. And this news came from a sort of strange place. It wasn't a big government announcement that you can't send H20 chips to China. It was a little bit more under the radar than that.
Right. It came through NVIDIA filing, and they disclosed that they're not going to be able to sell these H20 chips into China for the indefinite future. So that is a caution from the Trump administration that they don't want NVIDIA selling these chips that are used to train AI models to Chinese customers at this point. Now, note, this is the third series of restrictions that we've seen from the U.S. government towards NVIDIA in particular. First, in 2022, the Biden administration restricted their most advanced chips. Then in 2023, they restricted chips that NVIDIA had retooled to make available in the China market. And now we're seeing yet another set of restrictions. So this is a big blow to NVIDIA's ability to sell into China. They said they're going to take a $5.5 billion write-down in this quarter, as they report later on. And over the course of the year, it could cost them $12 to $14 billion, according to analyst estimates. So it is a big setback. NVIDIA would like to be able to sell into the China market. They're also worried that Chinese alternatives are going to get additional support from the Chinese government if they're not able to sell into the market. So they're worried about additional competition on that front.
Help me make sense of some of these numbers here, because we're talking about a $5.5 or $5.5 billion write-down, as you point out, the initial hit. At the same time as we're talking about a $500 billion investment into domestic infrastructure from NVIDIA as well. That announcement coming 24 hours prior to this filing. But doesn't that just make the cost of chips more expensive if you're manufacturing them in the States?
Well, the announcement that NVIDIA did with the Trump administration was a little bit different. They said they were going to produce $500 billion worth of AI supercomputers, as I recall. Now, they're not actually going to invest that amount of money. That's what they anticipate producing on the other side. But you're exactly right that these companies, NVIDIA, TSMC before them, are pledging big investments in the United States, in part to build a stronger relationship with the Trump administration so that they don't have to suffer from these tariffs. It doesn't look like it's working in NVIDIA's case, at least for this. We'll see how it plays out with TSMC and some of these other companies.
So what are we going to get tomorrow? What do we expect to hear from TSMC tomorrow? How big a moment is this going to be?
Well, investors are certainly on edge. As we see with ASML shares right now, we're seeing it with the chip stocks more broadly and tech stocks. Additionally, customers are very much on edge about what they're going to see from TSMC. They want to get some positive numbers. There are concerns that TSMC is going to take down their numbers and maybe also raise some concerns about these big investments in AI, whether they're going to pay off over the long term.
Peter, nice to see you.
Great to see you.
Peter Elstrom, Bloomberg's global executive editor for Global Technology Credit.
Let's go from the tech sector to the banking sector, because perhaps there's a little bit of nervousness and anxiety in the tech sector, perhaps a little more confidence in the banking sector. Bank of America's research team doesn't currently believe there will be a U.S. recession this year. CEO Brian Moynihan also sharing views on the U.S. growth outlook and rate path for the Federal Reserve.
Our research team, like many research teams led by Candace Browning, does not currently believe we'll see a recession in 2025. However, they've lowered their GDP growth rates for 2025 and continue to see no rate cuts during 25, but expect as inflation gets under control, you may see them in the future.
All right, Brian Moynihan there, the CEO of Bank of America. To get a little bit more context, we'll bring in our very own Charlie Wells, who's been covering the banking sector for us. Charlie, Brian Moynihan, Jamie Dimon, David Solomon, they were all very gung-ho on the U.S. economy. Two of those three names pulled back. Why didn't Brian Moynihan?
You know,
A lot of confidence. Trade war, what trade war? That was kind of, the outlook that we got there. And it's interesting, you heard from their CFO yesterday, too, talking about the resilience of the American consumer. And you saw on the Bank of America front, a lot of these kind of consumer issues pull through, right? So net interest income beat. They set aside less in loan loss provisions than was expected. And it's just seeming like, yes, there's a lot of talk about concerns about this trade war, but it's not necessarily coming through in those numbers. And so you kind of get this sense of, confidence, but of course uncertainty. So no recession in 2025, that's quite a statement.
Yes, a lot of unknowns still through 2025. We're only 16th of April, I suppose, and there's a lot still to play out. So where did that leave the banking sector then, as we heard it yesterday, Charlie? Because going into these numbers, we talked about concerns around the consumer. We'd get more clarity on the US consumer via Citi, via Bank of America. What did we get?
Big picture, it was kind of, I go back to kind of what Ted Pick at Morgan Stanley said, so pause, not delete. So this view that as long as these trade tensions get resolved quickly, some of the high expectations that we had going into this year could be positive. You got a lot of kind of nautical themes, oddly. So you had Jamie Dimon talking about, stormy seas, but then Jane Fraser, whose bank is incredibly exposed, they're the most international U.S. bank, you had her talking about being kind of a safe harbor in stormy times. So, I think trying to project strength as we hear so much uncertainty coming forward.
You see, Guy actually sails, so he's
not very often
all over these nautical things.
I think everybody's looking for the safe harbour at the moment. Banks are the best performing sector in Europe so far year to date. The sector is up by 13.3%. It is outperforming its benchmark by some considerable margin. We're about to start getting European earnings as well. What is the read across from one to the other? How are we set up going into that?
I think there's going to be less uniformity. I think you have obviously this geographic dispersion. So you've got, potentially different tariff rates on the UK versus Europe. I think you've got, as you say, these kind of tailwinds for European banking. You've got cross-border M&A. If we're in a more uncertain environment, does that get a pullback? You've had buybacks, which have been lifting share prices. If there is pressure on profitability, if there is a slowdown in loan growth, if the consumer is not borrowing quite as much, those buybacks aren't going to happen. So what happens to share prices there? And so I think, it could be a similar story. You might see kind of a positive uplook in some of these trading units at European banks, similar to what we've seen in the U.S. But even thinking big picture, if Europe, gets a deflationary kind of outlook from tariffs as opposed to that inflationary push in the U.S., that also creates, a rate environment that's less positive for lending.
Some of these banks have been posting decent numbers so far this year. SocGen, Commerzbank, TBC, Banco Santander, all up really quite nicely. Charlie, thank you very much indeed. Bloomberg's Charlie Wells on the banking sector. Lines out of China.
Yes, lines out of China, only one, basically. So the only thing to take away from the Foreign Ministry press briefing, the spokesperson Lin Jian saying the US should stop tariff threats and blackmail. This in response to President Trump's, I think his spokesperson read out a statement that he dictated that said that China should come to the table, they should pick up the phone, they should call the United States to try and do a deal. All these other countries.
It sounded like please call us, didn't it?
A little bit, yeah. They were saying the US doesn't need to do this deal, China, you need to do this deal. But yeah, the US calling on China to do a deal and China saying you need to stop with the threats and the blackmail.
And the tone from China, I just think in these kind of press conferences that we've gotten has completely shifted. That is some tough language coming out there. Previously, it was we want to negotiate, we want to have this conversation, we want to have an equal playing field, and that no longer seems to be the driving factor. And then on top of that, we're talking about Donald Trump launching a probe into the need for tariffs on critical minerals. That does include rare earths coming out of China. We're going to dive into the latest with Evie Hambro from BlackRock Fundamental Equities into that conversation. Where does that mean the kind of mining story, the critical mineral story, and of course the gold story lies? We're going to dive into those details next. This is Bloomberg.
Let's cut right to it. The
This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
This is the opening trade for 30 minutes into today's session, seeing a sell-off across the equity market, only down 1%, though. I say only with a giant grain of salt because, of course, we have seen bigger moves to the downside, but a lot of folks maybe liquidating some of their positions ahead of that long weekend on both sides of the Atlantic, plus, of course, the news that we're getting around NVIDIA, some of the tech stocks, and, of course, this ongoing geopolitical risk, Guy.
Let's talk about what is happening in the metals market. A couple of things to say here, one of which is the miners generally have not had a good start to the year, down pretty heavily already. We're watching very carefully, obviously, what is happening with gold. There's a whole precious metal story. And then there's the kind of the latest angle on all of this. I say the latest. It's been a sort of slow rumbling story. President Donald Trump launching a probe into the need for tariffs on critical materials, minerals, as I probably should say. The latest action, an expanding trade war that has targeted key sectors of the global economy. Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock Fundamental Equities, joining us around the table. I just want to start here because that's where the news is this morning. We can talk about gold. There's lots of other things to talk about. But China controls this market. America launching a probe into this, isn't it pretty obvious? China produces all of the critical minerals and basically controls the supply chain for them.
Yes, the rare earths market is a very bespoke niche market in terms of the kind of the quantity of supply. It's not like aluminium or copper, which is huge in terms of tonnage. So it's very small, but it's essential. Yeah. Everything that we rely on every day pretty much has some exposure to rare earths in it. And then you get some extreme uses in weapons and so on. So, China's position controlling that market, it gives them a lot of leverage. Now, what's a probe going to uncover that we don't already know? Maybe they're looking for something that we don't know about. I don't know. But I think the market's quite up to speed in terms of this. So maybe it's just part of the rhetoric that's coming out of Washington in this kind of long-term, I guess, view that materials are becoming weaponized. They are becoming, there's a war for control of these things because the world needs much more materials over a long period of time for decarbonization, data centers, all the things we know about. And access to these things is becoming critically important to governments. And governments are probably ahead of investors in terms of realizing just what they need to pay to get access to these things.
So that takes me to my next question, which is the materials that we require generally for the world economy to keep rolling. the world is becoming more fragmented, so therefore, in theory, becomes more siloed, kind of where this stuff is, and that in theory should be something that is puts grit into the sort of the process of moving this stuff around the world, and therefore probably should imply a slightly higher price. But then I've got a global economy that's slowing because of the same process. Yeah. That should, in theory, mean that we're going to see it use less of it, so that implies a lower price. So, which kind of how are you thinking about?
Where does it end?
Yeah. So
who wins? Yeah.
How do I balance out the kind of more fragmented, higher price story with the slowing global economy story, which should act as a drag? Where are we in the balancing act of those two things?
Yeah, and the missing item is supply, because that's the other side of the equation as well. So the things you've referenced are mostly around demand. So I think I tried to look at it as simple as possible, because that gives you a kind of starting point. And you take a commodity like copper today, you've got all of the tensions that you just mentioned around, is it going to be positive, is it going to be negative news, et cetera, et cetera. Copper's $4.60. Yeah, that's a fabulous price for copper. That's not a bear market price for copper. So that probably tells you a couple of things. It probably tells you that people are worried about supply, because where's the supply going to come from in the future? And therefore, could the price fall to too low a level where you start to see, well, actually, we're going to control supply. It's going to go lower because it's not a high enough price to incentivize new production. And then it also tells you about what the basic economic activity is. You've got all these macro headlines, but are people still building things? Are we still seeing decarbonization going on? Things might be going a little bit slower than we had hoped for in some areas. Are we still seeing the massive rollout of data centers? Are there more electric cars on the road every day? I mean, this is not like bad news as such. There's lots of macro headlines that are a lot of noise, but the underlying economic activity that we're seeing hasn't been significantly derailed. So I'm not too worried about that.
So, Evie, does that mean then the underlying? We talked a lot about the greening of the economy, the electrification of the economy, and all of the metals that were going to be needed to make that happen. The Trump administration creates a lot of news headlines around that as well. But does it fundamentally not look very different to you from how it did under a previous?
No, I mean,
administration.
We're very lucky. We get to speak to the companies and find out what their plans are and things, and like everybody does. And the plans that these companies have are very long dated. Just because there's been a short-term change, are you going to stop building the new nuclear facilities to power the data centers? Well, you're clearly not going to stop that. Are you going to stop connecting them to the grid? Are you going to stop putting all of the transformers and everything in to be able to do the supply? Are you going to stop building the data centers? Things might happen a little bit slower, but they're actually still going in the same direction. You're still seeing the largest deployment into solar and wind in the world right now. You're still seeing huge sales of electric vehicles. Maybe some companies have got lower sales, and some of the ones have got higher sales, etc. So, at the end of the day, the direction is still moving forward. And I think that the trend that we've been talking about for so long is that the world economy of the future is far more materials intensive than the economy that we're coming out of, because the economy we're coming out of was way more impacted by fossil fuels. And we're swapping fossil fuels for metals. And that's a trend that's going to last decades.
Okay, and what about that other trend that you started the conversation talking about, the sort of regionalization then of production because of the security concerns around access to critical minerals? How long a prospect, how long a time frame do we need to think about when it comes to trying to get critical minerals produced, extracted and processed, in the United States, in Europe, rather than bringing them all in from China?
Yeah, and that's a great question, because I think, you can see a lot of headlines saying we're going to do something really supportive to encourage the development of new supply in the US. But the reality is it takes a long time to build these operations. It takes an even longer time to get permission to build them. And you can try and fast track and put things through, but if you're trying to cut corners, you're just opening up the game to people who don't want this to happen, and they'll take you to court, and you'll get stuck there for years in a process. So how easy is it realistically to accelerate the development of new supply? I think it's not as easy as maybe some people at senior levels in the government are thinking.
Well, let's talk a little bit about the gold price here, reacting naturally to all the dynamics you've just talked about. I'm looking at 32, we'll call it 32.97 on the precious metal, record high, an all-time record high. What is it responding to? Is it responding to inflation fears that may come from this restructuring of trade, or is it coming from the opposite, a gigantic growth slowdown, recessionary fears?
Yeah, it's a great question. I mean, I'd love to have a pound for every time somebody said it's a record high in gold in the last few weeks. The gold market is kind of thriving in this period of uncertainty. But the foundations are very tangible and real. If you look at the gold market over the last few years, we've seen an extraordinary amount of purchasing of gold by central banks. So central banks became net buyers of gold about 15 years ago, maybe a little bit longer, having been net sellers for decades prior to that, way before even I started doing this job. And we've gone into this market where the amount of buying by central banks now is more than double the annual rate. And it's over 1,000 tons a year in a 3,000 ton a year gold market. That's a huge, huge number. So that's the first thing. The second thing is that the gold market is really starting to thrive now on retail purchasing. And if you look at the data around physically backed ETFs, they're starting to join the party. So we're getting that real retail buying coming through. And that's outside of the underlying physical buying, where if you go to the US now and you go to some of the big, supermarkets and so on, where you can go and buy gold over the counter, and they're having to restrict the purchases.
In a supermarket?
Yeah, at an individual level. You fill your basket with your milk and your chicken and everything else.
And a gold bar.
And I'll have a gold coin, please.
Okay,
Otherwise it'd be very heavy.
It would be very heavy. I'm quite dangerous getting it home. So it is extraordinary. So it's got that going on. And then the other thing is that we always like to look at gold and say, is it actually realistic, this price, relative to its own history? And the way you think about that is say, well, what is the cost of producing it? Are gold companies earning supernormal profits at these prices? And the answer is no. They're earning healthy profits. And that's actually quite sad, because the costs have risen very, very fast. And so for most of the last few years, costs have been rising faster than the gold price has been going up. And companies haven't been earning enough to reinvest, pay off their debt, pay dividends, and so on. And we're now going into this phase where the gold price has broken out into these levels, where the companies are actually capturing this higher price in profitability. And we're seeing buybacks being announced by some of the world's biggest gold companies. We're seeing new dividend policies coming through. And we're also seeing this kind of divergence in performance amongst the gold companies, where some companies have been good at capturing these prices and converting them into profitability, and others haven't. And this dispersion in performance has been very, very real. I'm sure your analysts can look at it.
Yeah.
You look at some of the world's biggest gold companies, and it's as if they're in different industries. The share price performance, which is just extraordinary.
Well, you can see it in I mean, just we had a fascinating story, I want to say a couple weeks/months ago, it's all a blur now, but the prices of the gold at the Bank of England versus the prices of the gold at the Federal Reserve is wild. I've got my producer to pull up a chart here of the 40-day price, which is as long as we'll go, but it's basically an exponential chart when you look at the gold prices. And when you see a chart like this, it reminds me a little bit of like Tesla stock or even Bitcoin, arguably. You almost always wonder if that's going to come crashing down. Yeah. And I'm curious what the ripple effect of that is.
Okay, I don't know what the ripple effect would be. I mean, people would lose money.
But is a crash for that kind of volatility coming? When you see a steep hockey stick move like that, could a crash be coming down the pipe?
Yeah, I mean, I think what we're doing is we're in all of these things, we tend to go into new trading ranges. And there's a price discovery process about going into a new trading range. And you've seen it in many commodities. You've seen it in oil and things over the years. And so people test the upside, and then it comes down again and test the downside, and you end up with a consolidation at a new price level. If gold manages to hold $3,000 an ounce for 2025, gold companies will make a fantastic amount of money. The gold funds that we run that are focused on the equities, should do pretty well in that environment. They're already up 40%
until you get
year-to-date
margin calls across the board and everyone liquidates gold, which is what happened 2 weeks ago with the stock market.
Yeah, I think that was more a function of a rush for cash. It was a de-risking that was going on in the market. It wasn't a negative on gold as such. Everything got sold. What was interesting is if you go back to, say, 2008, gold got sold off massively from August through to November. Huge, and there was huge collapse in the market. Gold, if you blinked, you missed the fall in gold last week. It was pretty short. So that tells you that there's this underlying activity. The China news earlier this week about China increasing the quotas to allow more domestic buying of gold. They wouldn't be doing that if they thought the gold market was going to go into some kind of crazy territory and would damage domestic investors. So, you kind of put it all together and you look at gold relative to the cost of production, gold relative to its purchasing power. I don't know whether you guys have seen the data around the iPhone. So when the iPhone was launched 16 years ago, it cost about $500 to buy an iPhone. If you said, well, how much gold would it cost to buy an iPhone back 16 years ago? It would be a certain amount of gold, about 0.28 of an ounce. An iPhone today, the new iPhone, is about $1,500 an ounce. So it's gone up 3 times in these fabulous banknotes that really look after your purchasing power through time. In gold, it costs you 30% less gold today to buy today's iPhone. So what has been the better way of storing your wealth and preserving your purchasing power through time? And I think young people today are learning, painfully, this lesson around the devaluation of paper currencies. And you look at, U.S. government debt going to new highs. I mean, you could talk about new highs in U.S. government debt and new highs in the gold price in the same sentence. And you look at it around the world, the servicing cost of this, the higher rates.
Okay.
And what brought the U.S. government back to heel last week was the move in the bond markets.
Yeah.
The servicing of this huge debt mountain.
Are we doing a full kind of reverse on Nixon? Maybe at some point. We'll maybe get back there.
Evie, thank you very much.
No worries. Thanks for having me. Yeah.
Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock Fundamental Equities, with a lot to say on gold. Coming up on the programme, UK inflation slipped lower for the second straight month. We dig deeper into today's data. Jumana Salaheen joins us, Vanguard Chief European Economist. The market moving to factor in a bit more rate cutting, it seems, from the BOE. We'll talk about that shortly. This is Bloomberg.
Had a number of games overseas in recent years, and in fact, you opened the season going to the opening game in Brazil. So do you expect to do more overseas games, and is that a part of your strategy?
It is. We had 5 last year. We expect to have 8 this year, which will be the highest we've ever had. Our hope would be at some stage to get to 16 games in the next few years. We think we can do that. I think it's an indication of the popularity of our game. Every time we take our game to a new market, Brazil's a great example of it, the fans go crazy for it. They sold out the tickets in less than 90 minutes. People had a wonderful time. It was the talk of the town. And I think it will be the basis and the sort of the match that lights the excitement and the popularity of the game in that market, as well as what we're doing around the world. So we're very excited by it. It's just one element of that strategy. You need to have television. You need to have activity and participation in the sport, and flag football is a big part of that. So all of those factors, I think, are going to be what we think will be a very successful formula to be a global sport.
Do you ever envision having a team that's based overseas in Mexico City or in London?
Listen, we've talked an awful lot about it, and I think there are markets that could, without question, support an NFL franchise.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. 47 minutes into today's session. I think what you need to know this morning is that equities are selling off and bonds are catching a bid. Of course, the geopolitical risk framing all of this. So let's get right to that story. The European Union and the U.S. making little progress bridging those trade differences this week. The Trump administration indicating that the bulk of the tariffs imposed on the bloc will not be removed. Bloomberg's Oliver Crook following the story in Berlin. He joins us now. Ollie, walk us through the readout from the meeting.
Yeah, Creedy, so listen, this is really the week in which the European officials are being sort of thrown at the Trump White House to try to make a breakthrough in terms of any kind of negotiating, getting any kind of picture of what the Trump administration wants. It began with Mauro Sefcovic on Monday, meeting with Jameson Greer, Howard Lutnick. Yesterday, we had Carlos Cuerpo, the Spanish economy and trade minister. And on Thursday, it's going to be Giorgia Meloni heading to the White House to have a direct meeting with Donald Trump. But we got a little bit more information of that main meeting of the week between Mauro Sefcovic and the Commerce Secretary, as well as the U.S. Special Trade Representative. And what he left with, Mauro Sefcovic, is not much more of a clear idea of what the Trump administration actually wants from the Europeans. So the Europeans are in this position where they don't really even know what they're negotiating with, but I think the bigger concern for them is they don't know exactly what they're negotiating for. How much willingness is there on the U.S. side to reduce those tariffs that exist on steel, aluminum, autos, 25%? We know those are sort of sacrosanct sectors for the Trump administration that they may actually not even be willing to negotiate for. And on this sort of 10% reciprocal tariff, are they trying to get that 10% down, or are they just trying to preserve that 10%? Because remember, after that 90-day period, you're going to get that number go up to potentially 20%. So it's not clear for the Europeans what they're negotiating for, what they're negotiating with, to say nothing of the fact that before that 90-day period, you might get a whole new litany of sanctions and tariffs on things like semiconductors, on things like pharmaceuticals, and of course now critical minerals.
So what does Giorgia Meloni need to do tomorrow? What are her expectations? Does she have a better chance than others, in some ways more ideologically aligned with the Trump administration? What are we looking for from that meeting?
Yeah, I think it's going to be the key meeting in a certain sense. I mean, I think that what we've seen about the personal relationships with Donald Trump in terms of making headway in trade negotiations, that may not be terribly encouraging. We look back to that meeting with Benjamin Netanyahu a couple of weeks ago over at the White House. But we'll have to see. As you say, Guy, Giorgia Meloni is the closest sort of political ally in a major European country, most ideologically aligned with Donald Trump. They have a good personal relationship. And as you know, you never really know with Donald Trump. Potentially there's a way of getting through. For her, it's maybe just a fact-finding mission to try to get an idea of what this Trump administration specifically wants from the Europeans. And we should say that she's also welcoming J.D. Vance on Friday within Italy. He's coming for a sort of Easter visit. You will remember his last visit at the Munich Security Conference and what he had to say there. But I think at the end of the day, if you really want to look for progress in trade negotiations between the EU and the United States, you may not look at the politicians. You may look at long-term U.S. Treasury yields and Eurodollar to see really the thing that seems to push the Trump administration to the table.
Ollie, thank you very much. Bloomberg's Oliver Crook with the latest on the EU trading position. Let's talk about the European economy then. Joining us now, Jumana Salehin, Chief European Economist and Europe Head of Investment Strategy Group at Vanguard. Jumana, nice to speak to you this morning. So that's the tariff conversation where we've got to so far, and there's a lot at stake, of course, for the European economy when it comes to that tariff conversation. How much of a slowdown in the growth story are you expecting in Europe? Or, just like lots of businesses we're hearing from at the moment, is it just impossible to say?
I think for Europe, we are expecting a slowdown. So when we look at, the European outlook, we look at the recent data. That will tell you where it's going. But on top of that, we'll also look at the news around tariffs, and that will have, a negative impact on uncertainty, business confidence, which will be a drag. So our own forecast for the euro area in 2025, we've downgraded it to 0.8, so less than 1% is what we're looking at.
And what role the stronger euro at this moment, what role is that playing? Should the ECB, and let me tie that into a rate cut question, because should the ECB be thinking about cutting more than 25 basis points to shore up the economy as a sort of preemptive measure, and mindful of the fact that the euro has already strengthened quite a lot?
Yeah, absolutely. When the euro strengthens, that's actually going to be, pushing down on inflation, because the important prices become cheaper, and so you see that effect. There's also another effect from trade. If trade gets diverted from the US to the euro area, you see more cheap imports there, and we know that that also drags on inflation. So these two factors are going to be looking down on inflation. For us, we're expecting the ECB to cut tomorrow, and we're expecting them to cut again later this year in the summer. Whether that's July or September remains to be seen. But the main point to remember is that the ECB interest rate is going to be now close to what is called the neutral, so no longer restrictive territory. And that's really where we expect those interest rates to settle, with inflation kind of going back towards trend, and growth is going to be a little bit weaker. So that's really where the uncertainty is on the growth side.
So it seems like, I mean, consensus here, and you just said it there, is that we're anticipating a wider divergence between the ECB and the Federal Reserve. If you look at the currency market, though, euro dollar is pricing in the exact opposite. Are we due for some sort of snap? How long can the ECB sustain that divergence from the Fed?
So I think that's a good question. And I think that really when you look at the currency moves, there's two things that are at work, Kriti, right? There's the interest rate differentials that work, but also what we think of as the long-term sustainable interest rate, right? So there's an anchor there. And so when you see that interest rate differential, can it be persistent on a short-term basis? Absolutely, yes. But you could see also some of those long-term factors, people reevaluating what the prospects are for the euro area in the longer run, what the prospects are for the US in the longer run, and that could also drive that persistence. But it can't go on forever and ever, right? So that interest rate differentials, ultimately, at some point you would expect, otherwise you'll see it in the currency moves.
All the data at the moment seems to come with ifs and buts. The Chinese data this morning, it comes before the tariff hit comes through. The Bank of England, the UK data this morning, we'll talk about the Bank of England in just a second, comes before a massive inflation hit comes through in the form of energy bills and all the other bills that we're apparently about to see hitting our doormats. What do you see happening with the Bank of England at the moment? How does it navigate a better trajectory with tariffs, an inflationary shock that continues in the UK, at the same time as a growth story that doesn't want to pick up? I know it's better than anticipated, but doesn't want to pick up. What do you see the rate trajectory looking like? Because the market continues to price in rate cuts from the Bank of England, but it's just so unclear as to whether or not they're going to be delivered or not.
Right, quite a few questions there. So I absolutely agree with you. Ifs and buts. We're at a time of heightened uncertainty, and that's why we have those ifs and buts, because, you know, it depends on what happens, and there's quite a few things changing, particularly in the policy sphere, which can be really important, right? The policy is the big thing which drives it. If the data is 0.1 up, 0.2 down, people can look through that. How do you navigate this? Of course, they always look 2 years ahead when they're setting interest rates. And so based on that, they'll be like, okay, where do we see the fundamental drivers of the economy? And the fundamental drivers of the economy are, yes, weak growth this year, but over time, you know, some recovery. And then on the other side, the inflation is going to be higher this year. But as you say, that weakness of demand brings that inflation down next year. So if we think about inflation, where it's going to end this year, it's going to be above target, but by the end of next year, below target.
The forecasting variability is enormous at the moment, though.
Absolutely.
So isn't the temptation, shouldn't the central bank just be sitting on its hands, trying to basically do as little damage as it can at this point, before knowing which way to jump? Like, it might have to jump higher, it might have to jump lower. There's so many risks around at the moment.
So what they will be doing is that, you know, the fundamentals are really looking ahead. It's really growth that's going to determine the inflation picture next year, right?
Yeah.
And we know that monetary policy acts with a lag. So they can't sit on their hands now, because if they do, they'll miss their opportunity. The weakness in growth, which is global, like globally we're dancing with a recession. We see growth below 1% in major advanced economies. And as you said, China's coming out weaker as well. So with that picture, we know at the end of the day, that's going to weaken the spending power that individuals have. And so you know that already, and so you think ahead. So we are expecting the Bank of England to cut at the next meeting and to have 2 more cuts this year on top of May. So that's 3 cuts this year.
Joanna, great to see you. Thank you very much indeed. Joanna Salahin, Chief Economist at Vanguard. What's for the rest of the day? Powell's coming up a little bit later.
Yes, he is. And in the meantime, US futures are weakening. We're touching session lows again on Nasdaq futures. Back to the tech conversation that we started the programme with, down by 2.3% there. That's coming up. Gold is rising once again, a new high. Don't know if it was something that Evie Hambro said, but the gold price keeps on getting higher.
Arsenal are playing Manchester. Arsenal are in Madrid tonight. That's the kind of the main story coming up. Can they defend that 3-0 lead that they currently have? Scott Kirby is a great conversation. It's coming up later here on Bloomberg. Looking forward to hearing from the United CEO. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
So the stocks rally gets fried by the chip sector. ASML tumbling after first quarter orders miss estimates. Nvidia slumping in pre-market trading. We'll show you that number in just a moment on new China export restrictions from Washington. That's the main story this morning. Tariff talks certainly a big focus as well. Tariff talks between the Europeans and the US appearing to stall. We'll talk about this in just a few minutes' time, with sources telling Bloomberg that US imposed levies on the bloc probably unlikely to be removed. Remember, we're in the 90-day pause period at the moment. Plus, President Trump says the ball is in China's court, apparently, to make a deal on tariffs. This as Chinese GDP growth beats expectations. Bit of front-loading maybe coming through from the exporters. We'll talk about that as well. Let's talk about where we are with the markets this Wednesday morning. Remember, shortened week coming up. You need to factor that into your thinking in terms of risk management. S&P futures currently are soft. They're down by 1.5%. The Nasdaq's the real story. You're seeing a big drop in the chip space. We've already talked about that. Obviously, we're catching a bid back into the 10-year. Euro dollar's trading 113.87. Brent crude is down by around 0.5% right now. Quick look at the European map. You are certainly watching very carefully what is happening in Amsterdam today in terms of the narrative. You're also watching very carefully what is happening with the German market, to a certain extent the French market. So the DAX is down by 1.2%, the AEX is down by 1.35%, the CAC 40 in Paris is down by 1%. The London market, Jurassic Park, maybe getting away with it, only down by 0.6%. So we need to talk about tariffs. We'll get you up to speed. That's what we're going to do right now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Morning, folks. I'm Guy Johnson. Let's talk you through what is going to be coming up on The Pulse and what we're going to be talking about. Tariffs, and the impact particularly on the chip space this morning. Let's check in and see what Nvidia's doing pre-market. We obviously saw a big gap lower first thing this morning in NASDAQ futures, and we're now seeing that replicated when it comes to Nvidia. The stock is down by circa 7%. Pretty similar move that we're seeing on ASML. So we'll come back and talk about both of these in just a moment and try and get an idea of what is happening. It's hard to kind of separate out the ASML story from the Nvidia story, but both fairly negative. The ASML book booking story is where the focus is, and it's the restrictions on these H20 chips that we're watching when it comes to the NVIDIA story. Peter Elstrom, Bloomberg's executive editor for global technology, joining me around the table. What is going on with these H20s? This was the chip that NVIDIA designed to sell to China. As you told me first thing this morning, the Biden administration was already thinking about adding restrictions. The Trump administration is now doing that. How big a surprise, therefore, is it?
Well, this is the third round of restrictions from the U.S. government on NVIDIA in terms of selling these AI chips into China. The first came in 2022 and then in 2023. There was talk in the late days of the Biden administration that perhaps they would stop NVIDIA from selling this very chip, the H20, into China because many Chinese companies are using this to be able to build their models. Notably, DeepSeek used the H20 to be able to come out with a model that kind of stunned the world a while back. The Trump administration is going ahead. They're saying that they cannot sell this chip for the indefinite future. That's having a direct effect on NVIDIA. They're taking a write-down of $5.5 billion in this quarter. An analyst estimate that it could cost them $12 to $14 billion overall. So it's a setback for NVIDIA, and perhaps just as important, it's going to motivate Chinese companies to move even more quickly in developing alternatives for these AI chips.
Okay, so that's NVIDIA. Let's talk about ASML. Okay. So they make the kit that the chip makers use to make the chip. So in theory, they're right at the start of the kind of the food chain, as it were, of the supply chain. And the fact that we're seeing bookings down as much as they are, is that a canary in the coal mine of what could ultimately be coming down the pike towards the entire sector?
Well, you're exactly right. They're very early in the supply chain. They sell to TSMC, to Intel, to Samsung, to the other chip makers as they try to produce these chips. So they're early in the chain. They would say, though, that these orders, bookings, are lumpy, that they come a lot. I mean, each machine can cost $400 million, so they kind of come in clumps. And they came in well below what analysts had been anticipating. They were supposed to come in at 4.8 billion euros. They came in almost a billion euros shy of that number. So it is a warning sign. On top of that, the company said that there's additional uncertainty because of the Trump tariffs. It's not exactly clear what kind of costs would be associated with that. If, for example, TSMC, as it builds these fabs in the United States, whether it has to pay tariffs on the ASML machines.
That's an amazing part of that story. Peter, great stuff. Thank you very much indeed. Peter Elstrom, Bloomberg Executive Editor for Global Technology. Let's come at this from a different angle. President Trump has called on China to reach out to him, pick up the phone, i.e., in order to kick off trade negotiations. The move is aimed at resolving the escalating trade war between the world's two largest economies.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
So the amazing thing here is that, therefore, Trump is reaching out, asking for them to pick up the phone and call the White. I don't know. I'm struggling with this one. Brennan Murray is going to clear it up for me. He's our global trade czar. This sounds like the White House wants a deal, needs to get a deal done. Trump is saying we don't need a deal, but it'd be great if you picked up the phone and called us.
Yeah, exactly. It was a remarkable statement from the podium of the White House press secretary yesterday, delivering this message from Trump directly to China to say, look, you know, we've started off with these high tariffs on you. You've responded methodically. They've cracked down on Boeing deliveries, and they've kind of sort of slow walked this through what has been a flurry of trade barriers that Trump has thrown up. I think what you're seeing is the art of the deal, the Trump style, bring the shock and awe, bring the high tariffs, meets the cult of President Xi Jinping, this idea that I'm not going to be bullied to the negotiating table, and then you have sort of the science of economics going, who can outlast the other the longest. So China is clearly, if you listen to the statements from the government, is not going to be, is not coming to the negotiating table under duress.
Okay. This takes me on to my next question, which is around the rare earths and the critical minerals. So China controls the market. Trump has launched a probe into the market. What is he expecting to find? China controls 85% of the market. I think we all know that, don't we? is there something that we should be looking for here?
Yeah, I think that the investigation that was launched over the past 24 hours is basically going to lay the legal groundwork for to see whether the U.S. can produce any of these minerals on their own or get them from other sources other than China. And if that can be established, then a tariff wall will have the legal justification for the tariffs that.
But my understanding is that basically China controls 85% of that market. It's built it up over years. It's taken an awfully long time to get to that point, and it's now there and is a source of considerable strength.
Yeah. I think in the meantime, the U.S. or the Trump administration would argue that will buy us some time to go around to our allies and try to figure out a way to shut down China's dominance. So it's three-dimensional chess going on here, and it's going to take months and months to figure out how the outcome is going to play out.
Brendan, great stuff. Thank you very much indeed. So Brendan Murray, Bloomberg's Global Trade Czar. Let's look at this from a European angle now. The European Union and the United States apparently making little progress in terms of bridging their trade differences this week. The Trump administration indicating that the bulk of its tariffs imposed on the bloc will not be lifted. Maroš Šefčovič has just been. We've had talks. Apparently it didn't deliver very much. Let's get an update on that meeting with Ollie Crook out of Berlin. Ollie, what happened at this meeting, if anything?
Yeah, it doesn't seem like a whole lot happened, right, Guy? I mean, this is sort of the week of the charm offensive for European sort of policymakers and emissaries and diplomats. It started with Maroš Šefčovič, then it was the Spanish economy and trade minister, and then tomorrow will be Giorgia Meloni at the White House meeting directly with Donald Trump. But that main meeting, the one that really has the mandate to negotiate any kind of trading deal with the United States, is Maroš Šefčovič, and that meeting happened on Monday. It lasted for about 2 hours, and within those 2 hours, I think it seems like Maroš Šefčovič left that meeting with as many questions as he came into it with. There is still not a clear idea of what the Trump administration is, what the Europeans are negotiating with in terms of the non-trade barriers. Remember, this is the thing that we keep hearing from the Trump administration. They have not laid out very clearly what it is that they want the Europeans to change in order to get a deal. But I think even worse, it casted doubt on what a deal could even look like, Guy. We know already you have those 25% tariffs, aluminum, steel, autos. Is the Trump administration really willing to even move on those? And as for the 10% reciprocal tariff, right, this is the one that's been dropped down to 10% for 90 days. What are the Europeans exactly negotiating here for? Are they negotiating to bring that 10% down, or are they negotiating to preserve that 10%? Because after 90 days, that will shoot up again to 20%. Again, all in sort of theory right now. So again, as far as negotiations work, as you know, Guy, you need to know what the object, what the prize of the negotiation is. Then you need to set a price. We have done neither of those things. We'll see if Giorgia Meloni can make a little bit of progress on that tomorrow with Donald Trump in person.
In theory, they should be maybe more ideologically aligned. We'll see whether that meeting tomorrow at the White House that the Italians have been so preparing for delivers anything. Ollie, thank you very much indeed. Bloomberg's Ollie Crook out of Berlin on the latest on the European side of all of this. Let's try and pull it together from a global perspective. The perfect person sitting next to me, Janet Henry, Global Chief Economist at HSBC. Good morning.
Good morning.
Is it possible to have a base case at the moment?
Well, we're economists. We have to have a base case, but I think...
Come with pretty big tails, though.
Very big tails, and I think, obviously, this is the challenge facing a lot of investors. You know, they have to take decisions to invest money based on either a central case or some hedging around it. But I think we are now in a world where, basically, anything could happen.
So what do we... How do you plan... How do you produce a plan for that? If anything can happen... And say you're a central banker, you're trying to figure out what to do. So let's kind of, you've got the ECB tomorrow.
Yep.
Bank of England's looking at the data it's got this morning. The Fed's trying to figure out what it's going to be doing as well. We're going to hear from Jay Powell a little bit later on. What do they do? This is a genuine question.
Yeah.
What do you do in this kind of world where you don't know what your tariff input kind of story is going to be? You don't know what the global economy is going to be doing. It's hard to model this stuff. You've got huge tails.
You think about what your mandate is. And for most central banks, your mandate is to keep inflation at acceptable levels, which in most cases is around 2%. Obviously, the Fed has to try to...
mandate.
Well, not...
Employment.
Employment. So they have to balance the unemployment with the inflation.
Yeah.
So everything they do has to come back to that. But they also have, I guess, another mandate, which is financial stability, which can interfere when you are trying to achieve inflation. And of course, we think back to what happened in the infamous Liz Truss moment not so long ago. And that's why we've even heard comments from Fed governors in the course of the last week that, yes, of course, they stand ready to respond to any financial risks out there. But basically, in a world of huge uncertainties where a lot of policies are being delivered, which may lead to an acceleration in prices, it's all about keeping inflation expectations anchored, making it clear to everyone that they value their credibility and that they are going to manage inflation irrespective of what happens. But that means they'll keep looking at the hard data. They won't be steered by what is pretty awful survey data are saying about the outlook.
Is the hard data going to follow the survey data?
Well, we don't know for sure. Because if you think about what happened, if you go back to when we saw the first upsurge in inflation, it was a case that actually inflation was starting to build, US consumer spending was very strong, the survey data was saying things were going to slow down. And now, of course, with hindsight, everyone's saying the Fed waited too long. Well, they waited too long because the survey was telling them that things were going to soften. But actually, the massive policy stimulus that we got on the monetary and the fiscal side, and people couldn't wait to get out of spend, led to that upsurge in inflation. So I think at the moment, that's why there will be caution from the Fed in particular, but also from others. All the data they're getting at the moment is all pre-April 2nd. So they're going to lag, if anything.
Do I need to separate out from a central bank point of view my thoughts on financial stability and the economy? Because I do slightly wonder whether they're beginning to diverge. Particularly, my example A is the US 30-year at the moment, which seems to be a buyer and seller issue rather than a macroeconomic issue that's affecting that market. But as you say, it does have a big effect back into the economy because mortgages are set and all kinds of other things are going on around that. Susan Collins talked about the idea that we could step in, we could help out if there is a problem here. How high is the bar for that, do you think, from the Fed?
Well, it depends how far they ultimately have to go, and indeed whether the markets themselves force a change in US policy responses. I think most people would agree that the very quick U-turn within a few hours of what happened on April the 2nd was that it was the power of the markets that made a massive contribution to that turnaround in activities. But I think if the central bank finds itself having to respond to financial stability, initially they might hopefully be able to start small in terms of liquidity provision. But absolutely, if you get a tailspin...
QE is on the table. So back on the table,
I think all instruments are on the table at any point. Should they be required, they would hope that to some extent you get back to the Mervyn King Maradona days, don't you? Where actually the central bank doesn't always have to do a huge amount because the markets anticipate what they might do and the markets themselves can impact on the economy. You mentioned the impact on the corporate sector, the household sector. For the corporate sector, the cost of capital has risen. You've seen the equity markets, you've seen the bond markets. That impacts on the macro outlook. It impacts on investment spending. It impacts on lending. And ultimately, that will impact on hiring. So, yes, it's all part of how the Fed is viewing the economy.
I'd take it one step further. Draghi didn't even have to do anything. He just sort of talked about it.
But talked very well.
But here in London. But how big a danger is there that you could have to see big QE again? Is that something that is on the table? Who is going to buy all these treasuries is a question that I'm being asked time and time again. People are talking about it. And I'm wondering if ultimately, and I've had 2-3 conversations already this morning about this, could it be the Fed?
I think we're not there yet. At the moment, we are still in quantitative tightening. We've already seen some tweaking around the edges in certain areas, and it's always about, the longer we take the QT, the longer it can happen for.
The Bank of England's backing off.
Bank of England, it was kind of, this is technical. It's not about monetary policy decisions, but it did follow the sell-off in the gilt market. So everything, as I say, is possible. But when you think about the treasuries in particular, maybe 30% of the treasury market is held by foreigners. The difficulty you have at the moment is the inconsistency on what the US is trying to achieve.
Yep.
They want to eliminate the trade deficit, which is not going to happen without a multi-year deep recession.
Yeah.
They want to have lower treasury yields, and they want to have a weaker dollar. They have to decide which of that impossible trinity they are not going to actually seek. But ultimately, you will have buyers of treasuries. It's at what price? And at the price will matter, because that will matter for the yield, which will matter for the real economy, which is what the Fed and central banks have to ultimately worry about.
I feel bad that I haven't talked a lot about Christine Lagarde here. The pound's coming up a little bit later, but Lagarde's coming up tomorrow. What message does she send tomorrow? Like, what does she need to communicate tomorrow about what the ECB is doing and the divisions that exist? And as you say, that the ECB in theory has got a single needle in its compass. Trichet, it is inflation.
Yes, it is, and it's about price stability. What she has on her side at the moment is that actually a lot of what's happening in the world, if anything, should mean that inflation gets back to target a little bit more swiftly than was previously the case, because the euro is a bit stronger, oil prices a bit lower, and of course you've got this whole possible disinflationary influence because of trade diversion, as perhaps not as many China products are going to the United States. But I think it will still be carefully as we go. You know, over the last few weeks, we did have a few ECB members talking about caution. I think the key message that will probably come out of their statement is that policy in the Eurozone is no longer restrictive. They talked about their kind of neutral range. We are within the range. The markets will be desperate to know, but what about June? Are they going to cut rates in June? And how far are they going to go? And I'm not sure we will get a strong steer in that regard. Again, uncertainty, enormous uncertainty. No one knows what's going to happen on tariffs. And actually, they will be thinking about the medium-term fiscal impact. So it will be, we're neutral, we're going to wait, we're going to watch the data, and then we will act.
Is the ECB's job, though, easier than the Fed's? I'm assuming it has to be.
Yes.
They appear to have more visibility. Therefore, the potential for cuts are greater. Is that the way I should think about it?
Well, the potential is greater, but the ECB has already done quite a lot. But you're right in terms of the mandate. You know, for the Fed, they know that growth is going to be weaker and inflation is going to be higher, but they will have to balance the two. You know, they probably think that growth is going to be a bigger impact than potential upside to inflation, but at least that, you know, they are moving in the opposite direction. For the ECB, this is bad for growth, and if anything, this will lower inflation, so at least both of those indicators are heading in the right direction. So in that way, it is more straightforward. But at the moment, they don't see the need for really aggressive rate cuts because they know they've got this fiscal support. But actually, we don't know what's going to happen on the fiscal side in the US in 2026. We've still got this budget appropriation bill coming through.
Base case with fat tails. That's where we started. Janet, very nice to see you. Thank you very much indeed for stopping by to see us. Janet Henry, Global Chief Economist at HSBC. Coming up, we're going to talk about what is happening in the UK. We didn't talk about that. UK inflation slipping back for a second straight month. It comes just before we see bills, utility bills, every other kind of bill, it seems, going up. So I'm just wondering how useful this data is as well. Anyway, we'll come back to that in a moment. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back. You're watching The Pulse. I'm Greg Johnson in London. Probably just worth pointing out, Nasdaq futures don't look particularly clever right now, down by 2.15%. That sounds like a lot, but actually in the reality of what we've been living through recently, maybe a 2% move on the Nasdaq isn't that bad. I'm not sure how many standard deviations we are off the normal, but I wouldn't have thought many. Let's talk about what's happening in the gilt markets. A little bit of movement this morning. We saw inflation data slipping back for a second straight month, but I don't know, anybody that has looked at their doormat recently has probably seen some letters coming through from utilities telling you that your prices are going to be going higher. So can I ignore this data? Are the data coming through next month going to be higher? And what happens after that? Well, let's try and answer some of these questions. John Stepek joining me around the table, author of Money Distilled, the newsletter that we have here at Bloomberg. Can I ignore these numbers? Are these numbers actually useful in as much as probably they are more aligned with what the longer-term picture looks like? Next month, inflation is probably going to go higher. I don't know. Tell me what's going on.
Well, I mean, OK, so inflation this month has been a little bit lower than expected.
Yep.
Now, so this month, obviously, is April. Next month, we get the April inflation figures. They are definitely going to go up 3%. They are probably going to go to something like 3.5%, maybe even a bit higher than that.
After that, though?
After that, low, you're probably talking about it staying around about the threes for the rest of the year, assuming that, you know, things stay roughly where they are just now. I mean, I think the important thing is that this has been, you know, this is in the price. People have been expecting this. The Bank of England expects inflation to go up to 3.7%. That was according to the last, monetary policy forecast. They've got one in May. The good news for the bank is that they're going into the May interest rate setting meeting with people's minds on the 2.6% inflation reading we've just had, rather than the 3.61 we're going to get after their meeting's over. So I think they've got a lot of political leeway at this point to cut rates. To
the government would be very happy.
Yeah, exactly. But I mean, I think the other thing you have to remember about the bank is I think the bank is cognizant of what things look like because they think about expectations. It's one thing to cut rates to 4.25% when inflation is officially at 2.6. It's a bit trickier whenever inflation's actually officially at 3.7.
How can you have a credible mandate of 2%? How can you be credible at 2% when you're cutting rates and it's at 3%? What does that tell me about the reality of a 2% target? Can I give up on that?
It's a useful fiction that was pulled out of the hat of the central bank in New Zealand in the 1980s. Yeah, but I mean, I think that the problem with all these things is you can't. We assume too much. And I think what it does tell us is that our fundamental models of the economy are not very good. The idea that, the Bank of England just sits there and twists the dials this way and that, and somehow it can get inflation back down to 2%. I mean, also, you talk about long and variable lags and the old Milton Friedman thing, it's going to take 18 months for this stuff to take effect. So the Bank of England has got to reserve the right to be able to look through the data, even though the data is actually, it's kind of messy and it doesn't look great. What I would say is that if oil prices have collapsed in the last, couple of weeks.
Where are we, 60-something? Yeah.
60 odds, even down to 50 odds at one point in Brent. And actually that fed through even to this particular one. And next month it should take the edge off as well. And also you've got the Trump tariffs are probably, Britain's probably one of the least badly affected countries by whatever happens with that. So it's not a disaster.
This is John being upbeat, by the way.
This is my optimistic face.
This is him being optimistic, just so you know. John Stepek, thank you very much indeed. We're going to talk chips. We'll get back to that story next. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. You're watching The Pulse, half past the hour. Equities are under pressure. Chips are at the centre of that. We'll come to ASML in just a moment. Before we do that, I just want to bring you a line that's coming out of China right now. China is open to talks if, and here's the big if, Trump shows them some respect, which is critical for Xi Jinping, and also names a point person. But maybe a crack appearing on the Chinese side and the possibility of talks opening up. Remember, yesterday we had this line out of the White House, basically the Trump administration asking the Chinese to pick up the phone and give them a call. The Chinese are prepared to do that with some conditions. Anyway, we'll come back to that in just a moment. Let's talk about what is happening with the market this morning. Under pressure a little bit on the stock front. The reason for that, we are seeing certainly the chip sector under pressure. There's a whole bunch of things that are happening here. ASML is under pressure. First quarter orders missing estimates. Nvidia slumping in pre-trade on those new China export restrictions that are coming through from Washington. In terms of the bigger story, tariff talks between the US and Europe appear to be stalling. Sources telling Bloomberg that US-imposed levies on the bloc will not be removed. Plus, President Trump says the ball, as I've just been saying, is in China's court to make a deal on tariffs. This as Chinese GDP growth beats expectations, but a front-loading maybe coming through from exporters. Let's get back to the chip story. We'll come on to the China story in a bit more detail in just a moment. ASML is down pretty hard this morning. Let me show you some numbers. As you can see, we are seeing losses across the piece when it comes to the chip sector. ASML, lithography maker, makes the kit that chip makers like TSMC use to make the chips that ultimately companies like NVIDIA need. ASML reporting bookings of just under 4 billion euros in the first quarter, nearly a billion shy of estimates. Charlotte Hughes Morgan joining me around the table. I've heard a number of people this morning talking about the fact that ASML's numbers are lumpy. These are big pieces of equipment. They are hard to kind of send around the world, and therefore orders tend to come in kind of lumps and bumps. Is this more than that?
I mean, totally. Well, that's certainly what ASML says. You know,
Yeah.
these are lumpy figures. The lead time on these machines can be 12 to 14 months. But I mean, you look at the shares, down 7% at the open. I think still about down around 5%.
Would they have been down? NVIDIA was down pretty hard already.
I mean, I think you've got a double whammy here, right?
Yeah.
I mean, you've got the NVIDIA news. That's obviously putting pressure on the entire kind of sector as well.
Yeah.
But ASML, you know, these results were the bookings, which are the most closely scrutinized metric, are down by 1 billion euros compared to estimates. You know, that is a disappointing result for them, and it says a lot about, you know, demand, customer demand, and investors are kind of having these conversations about whether the AI boom, this kind of huge momentum we've seen, can really kind of continue. And then on top of that, we've got obviously the tariff uncertainty that ASML themselves flagged.
I read the statement this morning. They're pretty confident on the AI story still.
They are. They've been doubling down on this. They're saying, look, we're having conversations with customers. 2025 and 2026 could be growth years. They're looking like growth years. AI is really driving the growth in the sector. So that's what ASML is saying. But, you know, we've seen analysts, we've seen some investors kind of flagging potentially there's some softness down the line in this market. You've had Microsoft walk away from some big data center projects recently. So you've got kind of two schools of thought here. But ASML, for their part, are saying AI is really driving this. However, across their whole results today, they have said, you know, there is this huge uncertainty hanging over the sector in terms of tariffs and trade tensions. And actually, okay, yes, if actually we were to see a recession or, tariffs were to start impacting spending, decision-making at their main customers, Intel, Samsung, TSMC, as you mentioned, if that was to start happening, well, then obviously that macro volatility would impact demand for their machines down the line, yeah.
Great to see you, Charlotte. Thanks very much indeed for stopping by to see us and updating us. Charlotte Hughes Morgan on what is happening in the chip space. NVIDIA is down, as we mentioned. They're all down. Hard to kind of separate out exactly what is moving what, but certainly NVIDIA was down heavily after overnight, and we're seeing pre-trade this morning down by, let's call it circa 6%. The company revealing, so this has come from the company, not the government, the company revealing that it is facing new US restrictions on chip exports to China. We're talking about the H20 chip here. So the Trump administration has barred the sale of the H20, this chip which NVIDIA specifically designed to comply with US regulations so that it could export them to China. IPEC Oscar Descaya, senior analyst at Swissquote, joining us this morning to talk about all of this. How easy is it to invest in a space where I don't know what's going to happen day to day? The beginning of this week, the news around NVIDIA sounded really positive. But here we are Wednesday, and we've got really negative news coming through. And I don't understand from an investment point of view how you get the visibility you need to make an accurate kind of investment into NVIDIA or the wider space.
Well, it's because it's impossible to say anything that's going to happen by next hour. So the uncertainties are such right now that the investors are totally paralyzed. We don't know what's going to happen in the next hour, in the next days, and the next months. The only thing we know that the uncertainties are actually leading companies to delay their AI investment decisions. And this is what we saw in ASML orders today. And we think that this instability and uncertainty environment will last at least for the next 3 to 6 months.
So let's talk about ASML. As you bring it up, and as you say, you think it's going to last, the uncertainty is going to last for quite a while. What is the lag between ASML having a weak order book, a weak bookings number, and that then feeding through into TSMC? We're going to hear from TSMC tomorrow, and then ultimately the end consumer. How long does it take for this process to unfold?
Well, it's quite long because ASML is selling machines to companies like TSM to build the chips, and then NVIDIA is making their chips built by TSMC, and at the end, the chips are being sold to the end client. So we do have a couple of months, there's 10 months there of lag. But at the end of the day, what we see is that the orders should come today in order for the companies to get their orders when they, well, initially thought they would. And right now, all the supply chain and all these outlooks is being pushed forward by at least 3 to 6 months, because we don't expect the dust to settle anytime soon, and the headlines are getting hectic and more hectic by the day, and no one really knows what's going to happen again, not for the chips, but for the entire geopolitical and the trade tension. So the fact that the tensions are escalating and we don't see through what's going to happen is having a material impact on appetite, both from the businesses who are delaying their investment plans and both from the investor side who are not really sure that even after the pullback that we saw in valuations, it's a good time to invest.
So what do you do? Is this sector, so this sector is investable still? How do I think about putting money to work in the tech space? What do valuations need to get to? Multiples are still reasonably punchy, and I've got this huge amount of uncertainty.
Well, it sure is. We think that the AI demand is strong and it will remain strong. It's just a temporary push, a temporary delay in investment decisions. So I think that's very important to understand. Right now, we think that holding the US technology stocks and trying to hold through the turmoil is a good idea. And we think that diversification towards other geographies and other continents is also a great way to deal with the uncertainties, especially regarding the geopolitical uncertainties and trade uncertainties. This being said, again, the AI demand is strong, and when we talk with investors, the only thing we hear is how fast this revolution is happening. They're all saying it's happening so fast that you don't have an idea. So many companies are still very much interested in AI solutions. Yeah. It is just that right now, we don't really know where to invest and how to invest in the middle of this trade uncertainty.
Can I ask you another question, looking at it from the Chinese side? DeepSeek obviously sent shockwaves through this entire sector. Does removing NVIDIA, the H20, from China slow that process down? Does it cause a threat to the threat that China poses to US companies in particular? Or are we going to see an acceleration, which is in some ways NVIDIA's argument, in China's ability to produce chips that can deliver the kind of performance that is required for China to be competitive and competitive at a cheaper price? How does that unfold?
Well, both. In the short run, we think that there is going to be a negative impact of the export restrictions towards China, so there will be an initial shock. But again, this is going to force the Chinese to step up their efforts, and Chinese have actually come through with quite interesting and efficient models, and they do have technology giants, and they do have means to get there. So we think that the developments on the Chinese side are going to be very interesting, because the government will also put all of its weight behind the technology sector in order to not get laid by the tariff and the trade war that's unfolding right now. So we think that what's happening right now between the US and China could be benefit to the Chinese technology sector more than otherwise.
Ipek, thank you very much indeed. Ipek Ozkardeskaya, Senior Analyst at Swissquote, joining us on what is happening in the tech space. The earnings season is beginning to gather a little bit of a momentum, and you want to keep an eye on what is happening with the credit space as this whole story unfolds. Let's try and get some analysis on what we're looking at right now. Mahesh Bimalingham joins us now, Global Head of Credit Strategy for Bloomberg Intelligence. What are we looking at in terms? Credit spreads in Europe have gone from extremely tight to being kind of averagely tight. Is that a good place to enter the earnings season that we're about to see, when potentially we're going to see a lot of withdrawal of guidance and we're not going to have a lot of visibility going forward?
Yeah. So we were priced to perfection, basically, at the end of Feb. Even before Liberation Day, we had a small correction. So, for example, if you look at junk, we widened by like about 50 basis points. But in the Liberation week, we widened by like 100 basis points, so 150 wider. So we went from price to perfection to very cheap in like a month and a half, right? So now, as you said, we stood moderately tight, No, I think we're moderately cheap right now.
Okay.
So it is not...
In high yield or in IG?
Both. High yield, lot more.
Yeah.
Low ratings have really sold off. Liquidity has really, has really come down in the bond space. So costs have gone up, volumes have come down, and CDS volumes have really like doubled, tripled, because people are hedging and they can't get rid of bonds in a downturn, for example, right? So lots of hedging going on. So where is credit right now? It's definitely not flashing any red warning signs. You're talking about the earnings cycle. So where are we as we enter? Right? So last quarter, we saw the first signs of small slippage in high yield. So if you're in the high yield market is obsessed with leverage, for example. So the leverage stats slightly slipped in the last earnings cycle. But remember, this comes on the back of 3 quarters of improvement.
Okay.
In investment grade, we continue to see improvement. This is before tariff season.
Yep.
So I do see some slippage in this quarter because the impact of tariffs wasn't seen.
Yep.
The slowdown wasn't seen. So we enter the earnings season in that mode.
Okay. I got a couple of quick questions I need to follow up with. The first one is, what I'm hearing is that particularly in high yield, bid offer is still pretty far apart.
Yeah.
And particularly the bid. People are putting some pretty aggressive downside bids in at the moment. What kind of visibility is that telling us about what comes next? If the market is still jittery in that space and the bids and the spread is still pretty, the bid offer spread is still pretty big.
Yes, I mean, is it like a complete crisis where you're not seeing
bids
in a bid? It's not that bad.
Yeah,
but definitely bid asks have gone up both in investment grade and high yield. High yield a lot more. We do track credit liquidity quite aggressively, like month by month, and we saw that round trip costs.
Yep.
So buy and then sell any given bond, that has gone up. Volumes have really dropped. Do I believe that this is going to improve? It depends on any sort of relenting and things getting back to normal on that front. This is on the liquidity side. Now, liquidity is also impacted by supply.
Sure.
And supply.
This is my second question. Yeah. Okay.
So supply has been impacted by,
this is primary supply. Yeah.
Correct.
Yep.
So thanks to what has happened in this crisis is the refinancing premium really went up.
Yep.
Right? Substantially went up. Particularly for high yield, it went from 27 basis points to like 140. In investment grade, it went from about 55 to 95. That has led to big drops in net supply. So high yield, we're used to having like negative net supply. I mean, that market has been suffering for some time. But the big story is the investment grade net supply, the chart that has just flashed up. We've had the worst net supply in a month ever since 2006. Now, the month is not over, I admit that.
Yep.
So we might see some supply coming in, but the point is the incentive to reissue has come down. When I say refinancing premium, what is that? It's the difference between the cost of a new bond versus an old bond. That number has shot up big time in high yield, so I don't expect much gross supply there. Even in investment grade, it has got worse, and you're seeing, we saw only 6 billion gross index eligible, while we saw like about 50 billion, 45 billion exit. That's why we are seeing net supply minus 40. It's unheard of. Even during pandemic, we didn't have that sort of a negative net supply number.
Tells you about maybe what is coming. Mahesh, we're going to have to leave it there. Great stuff. Thank you very much indeed. Mahesh B. Mellingham joining us on what is happening both in the primary and the secondary market on the credit side. Let's talk about what is happening in China. We'll talk more about this coming up. Apparently China says it's open to talks with President Trump, but setting a few conditions. Some respect maybe is required here. Anyway, we'll bring you the latest on that next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Just looking at dollar CNH, a little bit of movement in that on the headline that we brought you a little while ago, saying that China is open to talks. Remember, yesterday you had the statement from the White House talking about the fact that the White House would like to see China pick up the phone and start the process. China's saying it could be open to that. The US needs to show a little bit of respect and maybe rein in some of the cabinet members that are talking about this relationship. So you are getting a little bit of movement, so a weakening just slightly at the margin of the US dollar versus the CNH. Let's bring in Alan Wong, Bloomberg China Economy and Government Editor. Alan, how should I read this statement?
Right. The first thing to know, I think, is that China has always been saying that it is open to dialogue. But then, obviously, there's always the fine print, and China has always framed its openness to dialogue as a willingness to talk, as long as it is based on equality and respect mutually. But we are able to report today that China is open to talks with a little more specific conditions attached to it. First of all, as I said, China is demanding some respect, and specifically, it basically wants the Trump administrations to rein in some of the cabinet members who makes disparaging remarks about China. And then the other more specific conditions is that China wants the US side to appoint a person that it could have those talks with, which is understandable because we've seen how different members of the administration have said different things over the course of the last couple of months. And China is frustrated that it doesn't really know what the US wants from this negotiation. And this person, as long as he could or she could put together a deal that both presidents could put their names on, it's our understanding that China didn't designate anybody.
Okay. That's really interesting. But isn't the issue with that we ultimately see Donald Trump being the final arbiter of what the US side will accept? And isn't that the problem that we face here? That he's obviously thinks of himself as a deal maker and probably wants to be pulling the strings. Aren't the Chinese ultimately just going to be dealing with Trump? Isn't that the level at which this needs to be sorted out?
Yeah, I think we all know that Trump likes to deal with other leaders one-on-one to get them together in the same room and just hash it out between two leaders. But that's not how China normally operates here. And the bottom line is that China wants to deal with someone who actually represents or knows what Trump wants, so that any negotiation will have a meaningful outcome.
Yeah, that may be the challenge at the moment. Alan, thanks for the analysis and the insights. Alan Wong, Bloomberg China Economy and Government Editor. Phoenix Kalen, Head of Emerging Market Research at SocGen, joining us now to discuss all of this. Phoenix, how close do you think we could be to a deal between China and the United States? Still feels fairly far apart at this point.
It's difficult to tell. I mean, sometimes we think that deals are going to take months and even, years to negotiate, and then you turn around and things happen within 12 hours. So it's head spinning. It's kind of a soap opera type situation that's unfolding before our eyes. So it's quite difficult to determine. I think in terms of the tenor of discussions and kind of the language that's being spread out, then I think there is a chance for deals to be conducted over the next couple of months.
Does that have to happen at the sort of the ultimate level, i.e. between Xi Jinping and Donald Trump? Is that the level at which this needs to be sorted out? The Chinese are talking about the Americans appointing a point person. But these two leaders they're giants in their own worlds, and I'm wondering whether or not it is something that can only be sorted out at that kind of level. Do we need to see a summit at which we see a big deal being thrashed out?
I think definitely on the Trump administration side, it is something that I think Trump will need to sign off on. He wants to be completely hands-on in each of these negotiations with each country, not just with China. And he wants to put his stamp on it and kind of his seal of approval. And definitely on that side, I think Trump is going to be very proactive. I think on China's side, President Xi will want to engage his cabinet and take a much more kind of collective decision with, yes, of course, with him being the leader, but I think the approach on China's side is going to be much more long-term in perspective and much more sober.
In terms of how we think about where the world goes from here and the kind of the progress that we are seeing at the moment, I've been fascinated to see Xi Jinping going around Asia this week, trying to secure an economic sphere of influence. At the same time, I'm hearing the Treasury Secretary in the United States, Mr. Bessent, talking about kind of economic containment of China, using the trade negotiations that are currently being conducted to set up that kind of ring fence around the Chinese economy. What kind of a world are we heading into? What kind of a world are you looking at in terms of emerging market investing if we are going to see that kind of fragmentation?
Yeah, I think given the kind of expression that especially Bessent has articulated in terms of wanting to isolate China, first, partnering up with various trade partners, carving out deals first, and then approaching China as a group to isolate the country, then I think it sets China up to a situation where they have to go around the region and shore up as much support as possible. And so we're seeing kind of the extension of bamboo diplomacy happen in a lot of places in Asia. I think that is going to continue. And it'll be so difficult for a lot of the smaller economies to try to walk that fine line between, having a strong relationship with a huge trading partner like China, who's so close by, and at the same time not isolating the U.S. export market. So I think they will try to do that, but it will be just so very, very difficult. And it's maybe one where they can commit to certain types of obligations and promises to the U.S., but at the same time not try to overstep the boundaries with respect to what that means for Chinese investments and Chinese FDI in their countries, for instance.
Can I ask you a question about the currency? If China wants a sphere of influence around it, if it wants to have some stability in its own backyard, presumably having a stable currency is part and parcel of that. But at the same time, on the global stage, maybe there is a need to weaken the currency, maybe not at sort of destabilizing rates, but to weaken it. How does China balance those two factors?
So at this point, I think China really wants to step up as in contrast to kind of the image that the U.S. is presenting as being somewhat of a wrecking ball. China wants to be that image of stability, and part of that is going to be currency stability as well. And if we have a shock in terms of any kind of massive deval to the currency, that is going to hugely impact consumer confidence, hugely impact Chinese assets. So I think that's kind of off the table for the time being. That's the least preferred option, even though that might, kind of at the margin help exports. So I think the step is going to be maintaining relative stability in the currency, maybe very managed level of currency depreciation, very, very weak kind of, progression toward kind of a slightly higher dollar CNY over the coming months, but very managed in a way that's not going to destabilize sentiment in the country and still firm up confidence. So I think that's still key, and also projecting kind of the image of global power as well.
Felix, great to catch up. Really useful to get your analysis and your take on what is happening here. Felix Kalin, Head of Emerging Market Research, joining us from SocGen. So that's it. That wraps up the Pulse. Danny Berger up next with The Brief. markets at the moment look like we are seeing weakness, certainly on the equity front. You've got chip stocks particularly under pressure. We're heading into, obviously, a long weekend as well. Lots coming up in terms of the thinking around the risk management story around that as well. Arsenal going to Madrid tonight. That's also a fairly big story. Can he defend a 3-0 lead? This is Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. A warning from NVIDIA. The U.S. restricts sales to China even more, hitting the chipmaker with a multi-billion-dollar charge. Chips then take even more heat. ASML orders miss estimates. The CEO warns of tariff uncertainty. And the conditions for talks. China says it will agree to trade discussions, but lays out its list of demands. Will that calm over the past 2 days to start the week? Is it being upended? We're looking at a negative start to your equity futures session. NASDAQ 100 leads the losses, down 1.2%, with news that the U.S. has imposed restrictions on NVIDIA's chip exports to China, chips that were specifically designed to get around the restrictions to be sold to China. We are off some of the lows on the news that China is willing to talk to the U.S., but only under certain conditions. Maybe the good news, at least for today, is that yields are down, even though we are having risk off. We're down by, let's call it 4 basis points for the front end, 2.5 for the year 10-year. Your 10-year yield stands at 4.30. Again, you don't have that worrying dynamic of risk off plus higher yields. Meanwhile, gold continues to charge higher. There's a spot price for you, that very last asset, up 2.3%, trading above $3,300. That's your markets for this morning. Let's look at some of the stocks moving in the pre-market. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So it's all about the chip stocks today. Take a look at NVIDIA. We are down around 5% at the moment. The US banning the sale of the H2O chip in China, and NVIDIA coming out and warning of a potential $5.5 billion hit, sending the stock lower, and also peers in the pre-market as well. Then here in Europe, ASML missing significantly on its orders in its latest quarterly report. The stock was on course for its worst decline in around 6 months. ASML coming lower and again hitting rival chip makers here in Europe. A bit more positivity on airlines though. United Airlines jumping in the pre-market. The company made the unusual step of giving two forecasts. One if the US goes into recession, one if it doesn't. But overall, it was seen as a positive message, and also the rival airline stocks gaining as well today. As usual, all of that is available wrapped up in our Before the Bell opening wrap on the Bloomberg terminal now.
Joe, excellent work as always. Bloomberg's Joe Easton. Yeah, that United earnings really fascinating. Maybe this is the new playbook for companies as they try to navigate tariffs. So in just a few moments, we're going to be speaking to Peter Oppenheimer of Goldman Sachs. Later in the hour, Steve Rasciuto of Mizuho Securities. Two conversations that you do not want to miss. Let's get back to our top story. As Joe was just pointing out, NVIDIA shares plunging in the pre-market session, down at least 5%. The company warns that it could take a $5.5 billion hit from curbs on chips it exports to China. For more, let's bring in Peter Elstrom, Bloomberg Executive Editor for Global Technology. Peter, these H2O chips, weren't they specifically designed in terms that they wouldn't violate the export restrictions on the U.S.? Why are they being targeted now?
Yeah, that's right, Danny. This is the third round of restrictions from the U.S. government against NVIDIA as it tries to sell its chips into China. The first round came in 2022 and then in 2023 under the Biden administration. And now we're seeing the Trump administration move ahead with these H20 chips. Notably, what happened is the H20 chips were the ones that were used by DeepSeek to come out with its breakthrough model that we saw in January. Now we're seeing the Trump administration move ahead to try to block those chips. As you mentioned, NVIDIA is going to take a $5.5 billion write-down now for the first quarter. And on top of that, they're going to lose some sales. There are estimates that it could cost $12 to $14 billion for the company in the future. So it's a pretty big setback for them. They've argued that they should be able to sell some of these chips. Otherwise, Chinese companies are going to be even more motivated to try to develop some alternatives.
How likely will that be, Peter? What sort of symbiotic relationship is there? How reliant is NVIDIA on China, and how reliant are China tech on NVIDIA?
Well, Chinese companies have been trying to buy these chips. Even before the earlier restrictions, companies like Alibaba and Tencent had stockpiled even more advanced chips, the H100 chips that NVIDIA could sell a few years back in the past. But now Chinese companies are beginning to turn to some alternatives that they can buy. Domestically, Huawei has been quite aggressive in terms of developing an alternative called the Ascend chip that they are using for AI models. It's not quite as good as NVIDIA chips, but they are now being able to scale up. They're able to make some progress in terms of developing those chips. And again, the concern from NVIDIA, and they're trying to convey this to Washington, is that if you press China and don't allow them to buy some of our technologies now, they're going to move even more aggressively to try to develop domestic alternatives to these, and that's going to give them a broader foundation to be able to develop important technologies like AI.
Yeah, you got to wonder if that's going to happen regardless, given the current atmosphere. Peter, thank you so much. Bloomberg's Peter Elstrom. Let's talk about these broader equity markets. Joining us now is Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Peter, really great to see you this morning. Look, we went from expecting an exemption from semis and electronics on Saturday to kind of backtracking on Sunday, and now banning a large chunk of NVIDIA sales to China. Just given what we've had over the past few days, how difficult is it to make investment decisions to be bullish on overall equities in this type of environment?
Well, Daniel, it's a very good question. It's a real roller coaster ride, and the point that you make is a very good one. There's still a high degree of uncertainty about where we land in relation to tariffs and therefore the economy. And from that perspective, I think there's further downside risk to equities in the context of this bear market. This is a bear market that we characterize as event-driven. So it was triggered really by a set of tariff announcements that sort of derailed an economy that was moving ahead relatively well. It's possible, of course, that these tariffs are reversed or pulled back more, and that we'll get a a healthier recovery from this downturn. But I think a lot of investment decisions, both at the corporate level and from investors themselves, are just being held at bay at the moment as people wait to see. And that's going to create still further downward momentum.
Because it's interesting to talk about this being a bear market, Peter, when we are only down 12% from the highs. That on its surface, you could say this is just a correction. Is there then a mismatch between sentiment and how poorly equity markets are actually doing?
Yeah, well, sentiment is very poor, and this is true in the corporate sector and amongst investors because the degree of uncertainty is so high. Bear in mind that equities, take the US, was at one point down 20% or so. That's a normal characteristic of a bear market. We've seen a good rally, but we should also recognize that in most bear markets, you do get strong rallies as investors iterate every little marginal piece of news in the fear of missing a trough. But the rally that we've seen, I think, is vulnerable to reversing again, bearing in mind that equities are not that cheap. The US market is still trading at around 20 times earnings. That's around the 80th percentile. We don't think there's a lot of downside in valuation, but I think we do see more downside in earnings estimates. They're already decelerating quite rapidly. Our numbers are below consensus. And I think as those earnings numbers continue to come down, we're vulnerable still to a further correction in the nearer term in this equity cycle.
Speaking of earnings, Peter, we have talked to some people who remain optimistic on the market because of this idea that corporate America is resilient. But there has been a change just in the past 2 days in terms of how trade talks are going, and that is targeting a specific companies. We were just hearing from our reporter on what's happening with NVIDIA. Yesterday, we learned that China is telling its airlines to halt taking deliveries of Boeing. If we are in an environment where specific companies are being targeted, Peter, does that change the calculus?
Well, it changes it in the sense, again, that it should push up the risk premium because the ability to make and plan longer-term decisions for corporates and indeed for investors is that much more difficult. And as the risk premium goes up, it puts downward pressure on valuations. Having said that, it is important to also recognize there are some fundamental underlying positive support. So you mentioned that corporate balance sheets are strong. They are. Banks' balance sheets are very strong. And that, I think, will limit the extent and the duration of an economic downturn. And for that reason, we would characterize this bear market, this downdraft, as event-driven rather than what we would describe as structural, the type that we saw, for example, around the financial crisis, where a downturn in growth and asset prices really started to hit the private sector, banks, the real estate sector, and so on. I think the risks of that are very small. But, of course, heightened uncertainty is likely to weigh on investor and corporate decisions for some time still to come, I think.
What is that line? Is there a duration where you continue to get this uncertainty that it turns into event-driven to a structural bear market?
Well, I think, in our view, as I said, the structural bear market type risks, those of significant imbalances and over-leverage in the private sector, asset bubbles, the sort of things we have typically seen historically before structural bear markets are not really present. However, we could easily morph into what we call a cyclical bear market. That's the kind of bear market you get in equities around recessions as investors really start to price in fully the impact of a recession and the effect of that on corporate profits. And that's where valuations typically would need to fall yet further. Our own view is that a recession is not the most likely outcome. Our US economists look at the probability over the next 12 months of a US recession at around 45%. But of course, it could easily morph into a recession if this uncertainty over trade continues to weigh on investment decisions and triggers a further contraction in activity. And then we would expect to see, again, a little bit further downside in equities, but also the bear market lasting longer than would have been the case if we're in what we see as an event-driven downturn.
And certainly the sector, just differences between how they've been performing this year speak to that, Peter. You have the only two sectors that have done well are the defensive ones of staples and utilities. Would you expect that to be the thing that stays afloat in this market? Is that a playbook, an instructive playbook for how the rest of this year might go?
Yes, I mean, it's not surprising and consistent with our views that in a period of greater uncertainty, both on the economy and on investment decisions, that more defensive industries tend to hold up better because they're less levered or geared to economic outcomes, and that is playing out. We expect that to continue. I would also say that companies with stronger balance sheets are also more attractive in this environment, again, given the degrees of uncertainty, and also longer-term interest rates have remained relatively high despite expectations of policy easing. But of course, as we get towards a trough in this downdraft, the opportunity will also be, although we're not there yet, I think, to rotate into some of the things that have fallen the most, that may be more levered to a potential recovery. But that, I think, still has some time to play out before we get to that point.
Peter, it is so wonderful to have you on. Peter Oppenheimer of Goldman Sachs, one of the best. Let's get you some other top stories that are trending on the terminal this morning. ASML shares sinking after the Dutch equipment maker, reported first quarter orders that missed estimates. It cited weakness in the chip sector. TSMC and Intel are among its biggest customers. The CEO also said that tariffs have increased uncertainty. Meanwhile, in the UK, inflation dipped for a second straight month, offering some relief to households. The drop was driven by cheaper computer games, falling fuel prices, and unchanged food costs. Consumer prices rose 2.6% in March. That is the weakest print since December. The U.S. has softened its demands for Ukraine to pay back aid. Sources tell Bloomberg that the Trump administration cut its estimates for the assistance given to Kyiv from $300 billion to about $100 billion. That revision brings it closer to Ukraine's own estimate of about $90 billion. Coming up on the show, Bloomberg Scoop, China says that it's open to talks with the U.S., but only under certain conditions. We're going to lay out the details for you next on your Bloomberg Brief.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
promotional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
White House Press Secretary Caroline Leavitt at yesterday's briefing. And in a Bloomberg exclusive just out in the past 30 minutes, sources say that China is willing to talk with the U.S., but only under certain conditions, among them showing more respect. Joining us now is Bloomberg's Brendan Murray, who leads our global trade coverage, and from Hong Kong, Asia economy and government editor Alan Wong. Thank you both so much for joining this morning. Alan, let's start with you. What are the conditions that China is supposedly laying out for talks?
But China has always said that it's open to dialogue, but that it has to take place on an equal footing. So we just learned in greater detail what that exactly entails. So China is demanding more respect from the Trump administration in order for the talks to proceed. So what that means is partly that Trump should rein in some of its cabinet members who've made disparaging remarks about China, and because this expression of disrespect is impeding what China considers to be its willingness to talk. And the second thing is that China wants the U.S. to appoint a person to represent Trump in these talks. This is also not terribly surprising, given that we've gotten mixed signals from the Trump administration on many trade issues in the last couple of weeks, and China understandably is asking for the Trump administration to just point fingers at one person who could speak with authority and represent Trump's interests. And this can be seen as a small step forward because China has fleshed out a bit of the details of its demand for the talks to proceed. But I think it's worth reminding that China has always and publicly said that it's willing to have a dialogue with the U.S. Given the right conditions.
Well, it's interesting because it does seem like it was a little bit one-sided before this. Yeah, China had that willingness, but Brendan, we keep hearing from the White House, be it the president himself or the press secretary there, saying, China, please reach out to us, please come talk to us.
Yeah, exactly. It's playing this game of, who's going to pick up the phone first. I think it's interesting, the reporting that we have out of China today, in that what is the definition of respect? Does that mean roll some of the tariffs back? Does that mean, some kind of formal statement? And then the other issue of appointing a point person, this is really crucial for China because they need to know if they're dealing with the Treasury Secretary Scott Bessent. Are they dealing with, who's sort of a moderate when it comes to dealing with China and wants to do a deal, or are they dealing with someone like Howard Lutnick, on the more hawkish side? That will really determine how China approaches any sort of negotiation, and will send a signal from the U.S. as to how committed the U.S. is to reaching a deal if they get one of the more hawkish or dovish cabinet members from the Trump administration. So it's an interesting back and forth right now, a bit of jockeying to see who can come to the negotiating table and still maintain the leverage that they're trying to apply on each other from an economic perspective.
Well, Brendan, we also have this story. It would seem that the U.S. is also trying to target China in a not head-on way, but kind of a secondary effect way in terms of its negotiations with other trade partners, trying to pressure them to back away from China in order to reach an agreement with the U.S. What does this new strategy, again, as reported by the Journal, potentially look like?
Yeah, so we've had some reporting from our colleagues in Europe that the Europeans just met with the Trump's trade team earlier this week, and they've come away sort of confused and puzzled at what exactly the Trump administration wants, and so that could set the tone for these other talks. We know that Japan is coming to the table. The South Koreans are also scheduled to advance their talks. So it will be interesting to see how this plays out, and if China and the U.S. eventually sit at the negotiating table, we'll by then have a sense for how much the U.S. is willing to give in terms of tariff relief or other kind of measures that would be acceptable to the other side.
Alan, let me just quickly give you the last word, because we also had economic data from China today that looked very strong. What does it tell us about the place that China is coming from in these negotiations and its threshold for economic pain?
Yeah, honestly, the first quarter just sounded ages ago, and talking about past performance sound really quaint. But the data tell us that China was on a very strong footing, economically speaking, in the first 3 months of the year, with retail sales and industrial production both much better than expected, and investment was also stable and respectable. What this means is that China's earlier measures to, for example, provide consumption subsidies really worked, and that the confidence picked up a little bit. But then what we'll be watching out for going forward is just how much longer these stimulus measures will last and will have an effect on consumption, and of course, how the trade war will play out.
A lot to watch. Alan, Brendan, thank you both so much for your time this morning. Brendan Murray and Alan Wong, you're watching Bloomberg.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to your brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning. And a lot of these papers are not leading with tariffs today. This is what the New York Times is leading with, that Columbia University says it will reject any deal from the Trump administration that destroys its independence. Columbia's acting president says talks are ongoing. The White House is seeking to place the university under judicial oversight. And of course, less than 12 hours after Harvard became the first university to refuse to comply with administration's demand. Next up, the Washington Post has this. A federal judge is requiring the Trump administration to provide details of the attempts to return a wrongly deported man from Maryland. The order will require records and sworn answers from officials. Justice Department lawyers are arguing that the judge lacks the authority to force them to coordinate with the Salvadorian government. More to come. This is Bloomberg Brief.
What would it mean for India to host the Olympics?
Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. A warning from NVIDIA. The U.S. restricts sales to China even further, hitting the chip maker with a multi-billion-dollar charge. Chips then take even more heat. ASML orders miss. The CEO warns of tariff uncertainty. And the condition for talks. China says it will agree to trade discussions, but lays out its list of demands. A really excellent scoop from the Bloomberg team coming moments ago. That means we are off the lows, considering China is willing to talk, but still not a great future session. Is the calm upended? You can see those losses being led by the NASDAQ 100, down more than 1%. The Trump administration imposing even more restrictions on NVIDIA's chips, those shares down more than 5% in the pre-market. The good news for you is that yields are lower. The worrying dynamic had been risk off with bonds selling off today. That reverses, but it is slowing down. Your 2-year yield down 3 basis points at 381. Your 10-year down, let's call it 1 at 432. And gold continues to surge higher. That's what you're looking at, the last asset, up 2 1/3%. trading at $3,300 for an all-time new record. Now, as the market volatility persists, Stephen Rasciuto, chief U.S. economist at Mizuho Securities, remains optimistic, to some point writing that from this starting point, it is logical that a fundamentally healthy economy can absorb an artificially induced supply shock and avoid the type of credit-induced recession most market participants have experienced in the past. Pleased to say that Steve joins us now. Steve, great to see you.
Good to see you as well.
I mean, we'll take a little bit of optimism where we can get it. At what point do you start to worry, though, that it looks something more ugly, that it does look like a recession of the past?
But you need to have the preconditions in place. And you've got to remember, recessions are something that happen frequently. The ones that we're all paranoid about are the credit-induced recessions. And those are the ones that have existed since 1990. And we've had 4 of them, if you assume COVID was a credit recession as well. All the other recessions were very, very different in nature. They were shorter, shallower. Several of them we were in and almost out of before we realized we were even in them. So there's big difference in the variety of recession. And people have come to assume that every recession is a credit shock. They're not. The preconditions for a credit shock are not in this economy.
Does it look something then more maybe like a Brexit, where it's slow moving, you have maintained global ties, and things generally are worse?
You know, I think that the point that comes down to at the end of the day for everybody is this is the consumer of last resort. Okay, this is also the largest, most leveraged economy in the world. It certainly needs foreign participation to be involved in it. However, the only thing that influences is the price. It doesn't influence the ability of things like the government to fund itself. So I think people are overreacting to things because they want to read into a story that says, Fed's got to cut rates, Fed's got to bail us out, Fed's got to go back to QE, because, hey, we can all make money in that environment. Well, that's not the way it's going to play out this time. I'm sorry to tell you that. This is a very, very different macro environment. This is not a credit crunch that's unfolding in the economy. Liquidity is still available. Markets are still very accommodative. Corporate deals are getting done. We had a very, very large high-yield deal come the other day. We've got another one coming real soon. We're doing IG-related issuance. They're getting done at very, very good levels. So I think the reality is the economists and the strategists are panicking. The rest of the world is not.
I wonder then, because part of the narrative that formed when yields were heading higher, at least on the long end, when assets were selling off, that, okay, if we head into a recession, we're already coming from high levels of a deficit. In a recession, you end up spending even more, and therefore you're concerned about debt levels. Does that not hold true this time if we're not going to get into sort of a garden variety economic time of weakness?
Well, I mean, again, you have to consider the total demand for leverage as opposed to just the Treasury's demand for borrowing. Okay, when you look at the total demand for credit, all non-financial debt, including the budget deficit in this country relative to GDP, is 225%. We were as high as 250 during COVID. Europe is running at around the same level, believe it or not. Japan is running at 425%, and China is running at 325 and rising. So the reality is, does it look all that bad? Not really. And this is where I think you can look at something and you can identify and say, oh my God, this stands out like a lightning rod. But when you look at it in a broader context, it's like, okay, it's just another thing we have to ride through, and we'll get through it without a problem.
But surely it looks different on the other end, Steve. If we're riding through something where we're almost decoupling from China. Yeah, we're talking about talks today. We're pushing ourselves away from the Europeans, and we're also asking other countries to push away from China too. Surely we ride this out, but on the other end of it, something has changed.
Well, it does, but at the end of the day, is that the end of the world? Just because it changes at the end of the world. Think about the post-World War II approach towards the Soviet Union. Right? We totally isolated the world from the entire eastern portion of the world, okay? Russia and all the Eastern European countries, totally isolated away from them. We weren't really engaged with China at that particular time. It was a very different China. The reality is Russia was a bigger component immediately after World War II than people consider it actually was. Russia at one point in time, the USSR, as it came to be known, really had enough ability to really compete with Western Europe and the United States. China doesn't seem to have that level of muscle. So I think, you know, when you put it in the broader perspective of what's going on, we tend to just think about our universe. And yes, our universe is changing. The reality is the underlying economy has dealt with things like this before. It is a different economy, and actually it's a more robust, more sustainable economy, because this is an economy that's driven on services. This is not an economy that's driven off manufacturing.
Fair enough. The manufacturing numbers have looked poor, but to your point, it is economy based on services. I mean, I got to say, David Solomon, I wrote this down from the Goldman Sachs earnings. He was saying it is important to recognize that a few countries have benefited more from the post-World War II economic and financial order than the U.S. Is there a case then where we get through this, we're still strong, but less strong, that growth and maybe even productivity is lessened with the changes that are put into force?
I think you wind up with a higher rate of inflation and a higher rate of interest rates. Now, there's some people at the Federal Reserve who honestly, going into this overall environment 2 years ago, were sitting there saying, hey, 2% inflation target is probably too low. We should probably looking at 3, maybe 4. So at the end of the day, if we come out of this with 3% inflation, is that really so bad? If your wages are going up at 4% and your inflation is going up at 3%, purchasing power increases, is that so bad? It's different than we experienced, but change isn't always bad.
What do you make then of most recent Fed speak, Waller kind of being the exception, being like, the mission needs to be to make sure inflation expectations are well anchored? That seems to be the conversation, unless you are Chris Waller, who says recession concerns are more frightening.
Well, I think the answer is very, very simple, is that the Fed has a dual mandate. And so far, the labor market's doing well. The inflation is now in jeopardy. Going into the tariffs, the Fed was sitting there saying, I have a deflationary bias, so I can focus on the labor market. So now, is there a subtle shift going on, possibly, from the labor market component back to the inflation component? There's nothing wrong with that. It's an appropriate monetary policy response. But again, it suggests the problem is not necessarily with the Fed. The problem is with the Fed funds futures market saying they're going to cut rate 4 times this year. That's the problem. The markets, not necessarily the policymakers.
Steve, it's great to have you on when you're so level-headed in a time when it feels like markets are not. Thank you so much for joining this morning. Great to have you. Steve Prosciutto of Mizuho Securities. Okay, coming up, China says it's open to talks with the U.S. If the U.S. starts showing more respect, we'll lay out those conditions that sources say China is starting to outline. That's coming up next on Your Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
In case you missed it, on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month only on Bloomberg.
NVIDIA, it's one of the great companies of the world, modern, super modern companies, controls segments that nobody, sort of controls the world in a sense.
How different the difference a couple days makes. President Trump talking about NVIDIA just on this Monday, but on the same day, the administration told NVIDIA that it's banning it from selling its H2O chip in China, down 5.5% in the pre-market, with the chip giant saying that it could take a hit of $5.5 billion from the restrictions. For more, let's bring in our Bloomberg senior editor for tech and strategic industries, Mike Shepard. I mean, Shep, wasn't this chip specifically developed to get around chip restrictions?
Well, that's right. They had designed this H20 chip to meet and satisfy previous curbs that have been imposed on sales of semiconductors, advanced semiconductors to China, really since 2022. And the U.S. has been concerned that these chips could be used to help give Beijing something of an edge in artificial intelligence, but also be used in military applications as well. So they invented this H20 chip with scaled down capabilities, yet it proved to be good in another area that's key to artificial intelligence, and that's something called inference. And it is something that is believed to be behind DeepSeek's success and that of other Chinese startups in making some inroads when it comes to artificial intelligence. So this was widely expected to be coming. Howard Lutnick, the Commerce Secretary under Donald Trump, within days of taking office, the administration had signaled something like this might be coming. And for all of Trump's praise of NVIDIA and for Jensen Huang's meeting at the White House with Donald Trump, it really didn't seem to help. The U.S. sees this challenge from China in areas like tech and trade as something that they really have to take steps, including some extreme ones, as we see in the case of NVIDIA, steps that they have to take, Danny.
It's a changing contour where it's not just overall trade level that's being targeted. It is individual companies from NVIDIA to Boeing. But Shep, it does seem, at least according to Bloomberg reporting, that China seems willing to come to the table, but it's laying out conditions. What are those conditions?
Well, it sure is. And, Donald Trump yesterday, through his press secretary, Caroline Leavitt, kind of said literally, the ball is in your court, China. And now we're seeing Beijing volley back this morning. And our reporting signals that they are laying out a couple of conditions to be willing to engage in talks on trade now with Trump as this confrontation escalates. One, they would like to see a point person from the administration, somebody who has Trump's ear, but is not Donald Trump himself, to actually carry out these negotiations with the senior member of China's government. And Beijing just replaced their key trade minister in the last several hours, too, as perhaps a sign of their interest in advancing this. The second thing is they want key issues on the table. They would like to make sure that the tech curbs we were just talking about are included in the conversation. And they also want to make sure that the question of Taiwan, the self-governing island that has been this point of contention between Beijing and Washington for so long, is part of the discussions. And then three, they would like to see a more respectful tone from the U.S. Beijing has taken exception to some comments that it sees as disparaging from senior U.S. officials, including J.D. Vance, in recent weeks. And they want that kind of rhetoric to be dialed down for there to be any sort of conversation on trade, and including on taking steps that might see an easing of the U.S. tariffs that were imposed over the past several weeks, Danny.
Yeah, J.D. Vance using the phrase Chinese peasants, which received a lot of condemnation from the nation. Shep, just finally, there's some Wall Street Journal reporting that kind of echoes some of our own reporting, this idea that the U.S. is saying to its trading partners, it's either us or China. What does this fold represent in trade negotiations with the U.S. and other nations?
Well, you can sort of see this split emerging naturally. The European Commission trade chief was in Washington this week. It didn't yield a deal. The Trump administration likes to talk about, quick results. But trade negotiation usually takes years. They have a faster timeline now with the reciprocal tariffs that have been held in temporary abeyance. But that is one area where we are seeing what you could call progress. By contrast, there is not nearly that same level of engagement with Beijing. And likewise with other key U.S. trading partners like Japan, like Korea, you're also seeing leaders and officials quickly stepping in to try to engage with the U.S. So it is almost like a bifurcation in terms of how the different capitals and different blocs are engaging quickly with Washington versus Beijing. It's something that's happening sort of naturally. And some of the groundwork had been laid early in the administration by those governments and by the EU in a way in terms of reaching out to Washington and vice versa. Whereas with China, there really has not been that kind of high-level engagement or contact right away. And the differences are stark. And the Trump administration really would like to see this turned into much more of a you choose China or you choose us. And we are trying to make the terms as favorable for you as we can.
Shep, thank you so much for keeping us up to speed. A lot to get through. Bloomberg's Michael Shepard in Washington. Now let's turn to tech because ASML shares are sinking alongside NVIDIA. But this is because of their earnings. The Dutch chip equipment maker reported first quarter orders that missed estimates. It cited weakness in the chip sector. The CEO also said that tariffs have increased uncertainty. Let's bring in Charlotte Hughes Morgan, who joins us now on this. Charlotte, what did we hear from ASML?
Thanks, Danny. Yeah, it's more gloomy signals, I'm afraid, from another key player in the AI supply chain. I mean, remember that ASML is the only company in the world that is capable of producing these advanced EUV machines that make the most sophisticated chips that are used by the likes of TSMC to basically power the AI boom that we've been seeing. And at ASML, the key metric for them is bookings. So their first quarter bookings missed analyst estimates by about 1 billion euros. So we saw them come in at 3.9 billion euros for the quarter. Analysts had been looking at more like 4.8 billion. So that is obviously a disappointing result as far as bookings are concerned. Now, the company says, you know, bookings are a lumpy figure. The lead times on some of the machines can be really long. But actually, that is the metric the market is looking at. And we see that reflected in the shares, right? We had ASML opening down 7% in Amsterdam today. Now, one thing that it is important to note is they kept their 2025 net sales guidance unchanged, 30 to 35 billion euros for the year. However, something that they did flag, essentially a tariff disclaimer. They said, you know, subject to the uncertainties we're seeing in the macro environment. So investors are definitely kind of watching that closely and trying to kind of work out what will be coming next for the sector.
Charlotte, that's exactly where I wanted to go because we are seeing a fascinating divergence between companies on how they handle their outlooks. ASML, as you mentioned, is keeping it. How is it interpreting tariffs? How is it going about communicating to the market just the type of impact that it might have down the road?
And it's a really interesting question. And I mean, ASML were quite upfront about the fact that they don't really know. I mean, the CEO in the release saying, we don't yet know how we're going to quantify the tariff implications and flagging there's a huge amount of uncertainty, but they are obviously communicating with their customers and keeping an eye on the situation. And interestingly, the CFO in the video that is released alongside earnings basically laid out a number of different potential scenarios for these kind of sector-specific semiconductor tariffs that the U.S. administration is planning to levy on these companies. And it, you know, looked at everything from tariffs on the whole system, so the whole of the lithography machine, tariffs on certain parts, and they also considered the scenario where other countries actually levy tariffs on products coming out of the U.S. I mean, ASML actually has 20% of its headcount in the U.S. It has manufacturing capabilities there. So all kinds of scenarios could play out. But I mean, this unpredictability, this uncertainty is clearly weighing on the shares, and it's really weighing on the sector as a whole.
Yeah, it feels like this quarter is just a practice in scenario analysis. Charlotte, thank you so much. Bloomberg's Charlotte Hughes Morgan. Now, speaking of scenario analysis, United Airlines taking the unusual step of offering two potential earnings scenarios in its outlook. It said that its 2025 outlook does remain achievable, but it also warned that a recession could nearly have its profit forecast. Joining us now is Bloomberg senior aviation reporter Sid Phillip. Sid, just how unusual is this, the fact that we got two different forecasts coming from United?
It is very unusual. I mean, most airlines put out one scenario, and so this is actually very unusual for an airline to come out with two scenarios. But at the same time, it sort of shows the limited upside, the downside risk for United. I think United is trying to calm market fears, saying that, okay, there is a bottom in case there is a recession, then profit estimates will be halved. But at the same time, it's not as dire as anyone could predict it to be. So I think they're sort of trying to put a bottom on the sort of expectations that it wouldn't be below this. And that has sort of enthused the markets a little bit because the shares were up in pre-market trading and the other airlines went up as well. Because remember, last week, Delta Airlines pulled their forecast for the year because of the uncertainty. So United's trying to come in and say, this is the floor for where earnings could be.
That is such an interesting idea, Sid. The fact that this was really a playbook for if you want to say things are uncertain, but you don't want to get crushed in terms of your share price, this is the kind of thing that you can offer. Can we talk about that downside scenario? Because as you say, it puts a floor on it, so our imaginations don't run wild. What exactly does that floor look like?
It does look like, I mean, the moment it's still, they're talking about how it could be halved from what their previous expectation was. And essentially, we still don't know for sure they are pulling out capacity. They're pulling out capacity in the third and fourth quarters. They're retiring planes earlier than they previously expected to, as well as sort of making sure there's not excess capacity in the market. At the same time, they are very dependent on international flying as well as on their premium traffic. And those are two sectors that could be hit in case the tariff war escalates further, as well as people sort of feel the pinch in their pockets and sort of downgrade to less lucrative economy travel.
Yeah, it will be interesting to see if those are affected. So far, it seems like only domestic travel has been impacted by some cuts to the government. Sid, thank you so much. Bloomberg Sid Phillip there. And later today, a conversation you don't want to miss. United Airlines CEO Scott Kirkby joins Bloomberg Surveillance. That conversation at 8 a.m. New York and 1 p.m. UK time. Coming up, we get another read on the U.S. consumer and more Fed speak. We'll lay out your agenda for you next on your Bloomberg Brief.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's get you set up for your trading day on this Wednesday. U.S. retail sales for March come out at 8:30 a.m. Plus, we'll get the Bank of Canada rate decision, 9:45 a.m. And Fed Chair Powell speaks at the Economic Club of Chicago at 1:30 p.m. New York time. A busy day, started by a busy evening last night, bleeding into the futures session. NVIDIA, AMD, Intel, all falling. Some of that has to do with ASML earnings that were very poor, but also NVIDIA taking a beating this morning, down more than 5.5% after saying that they would take a $5.5 billion charge because the Trump administration is targeting their H20 chips and their ability to send them to China. Now, on this risk off, we're seeing a big move in gold. Recall that yesterday we learned gold was apparently the most crowded asset according to the Bank of America survey. That's not stopping more people from piling in. We're trading about 3,300 this morning, up 2.33% or thereabouts, easily at a new all-time record. All right, that is it for your Bloomberg Brief. Thanks for joining us this morning. Surveillance will take the reins from here. This is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
the market is currently making a major potential reassessment of valuations of U.S. assets.
It's not a necessary sell everything type of an environment.
I have a difficult time seeing where the genuine new positive catalysts are going to come from.
A lot is going to change day to day and week to week.
Uncertainty is high, not just for the economy, but for investors.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, and the White House is pushing for China to come to the table.
The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, the American consumer. Or to put it another way, they need our money.
This morning, the conditions. According to people familiar with Beijing's thinking, China wants to see much more respect before agreeing to talks. This after tensions ramped up overnight as President Trump barred NVIDIA from selling its H20 chip in the country. Weighing on chip stocks this morning, ASML, reporting orders that missed estimates, and the company warning it doesn't know how to quantify the impact from recent tariff announcements.
To me, that was one of the most interesting aspects, because how do you quantify a potential 145% tariff rate on China? There already have been restrictions. As we see with NVIDIA, you pair these two stories, those restrictions can change. They made this chip specifically for China. Suddenly, it is now exempt, and they cannot profit from some $5 billion that they were expecting in revenues. Key question here, what is the ultimate goal? Is this national security? Is this trying to sort of get some sort of trade deal? Or is this something else that we haven't put our finger on?
How do you guide with limited visibility? Do you do it at United Airlines? I have to say, the C-suite's starting to sound like a Wall Street strategist. Here's my base case, here's my bear case. That's what we heard from United yesterday.
And they kind of have to, right? They talk about one case where potentially their profits could be $13.50 a share, or it could be $7 a share, depending on whether you get a recession. Mohamed El-Arian came out and he said this, and it was on an X post. I thought this was fascinating. This is why it's important to think in terms of multiple scenarios for internal planning and not just stick to the usual. Is United the path ahead?
United and Scott Kirby coming up a little bit later on this morning, so look out for that conversation. We've got to unpack the China issue as well. The issues and the approach. China wants a point person. Based on our reporting here at Bloomberg, Wall Street wants the same. And I think we heard that from Jamie Dimon in the FT just yesterday.
Yeah, Jamie Dimon said that he knows Scott Bessent a little bit. He thinks he's the adult in the room, and he thinks he should be the person leading those negotiations. When I spoke to Scott Bessent earlier this week, what he did say when it comes to the trade negotiations that are starting to develop right now, not with China, but other trading partners, he says there is now a process in place. Potentially they can get the 70-plus countries done first and then confront China, but at this point, they will have a process that is in place.
Our report just showing a small glimmer of hope that maybe China will come to the table. You see the equity move? Bang, up, just like that. This is what the market is looking for, is what it's hoping for.
What you saw in futures was really just, it had been creeping lower to almost 0.5% down. All of a sudden, boom, almost flat. And this is essentially the off-ramp that people are looking for at a time when potentially that is the only hope to avoid a scenario that, as many companies are saying, they cannot even start to quantify.
China has finally responded. We've heard time and time again from the President of the United States saying, basically, we're going to be gracious. I'm waiting for Xi to call. But can they meet this bar? They want to appoint a person, willingness to address China's concerns on sanctions and Taiwan, a more consistent U.S. position, and then respect and reining in disparaging remarks when it comes to China. That may be difficult for some members of Trump's cabinet.
Equities recovering this morning, still lower. We're down by 0.7%. Coming up this hour, Jack Caffrey of JP Morgan Asset Management. As stocks snap a two-day winning streak, we'll catch up with Dan Clifton of Strategas as the White House puts the ball in China's court, and Erica Najarian of UBS as big bank earnings wrap up on Wall Street. We begin this hour with stocks recovering on signs China is willing to talk. Jack Caffrey of JP Morgan Asset Management writing, even with a pair of rallies last week that managed to produce a year of normalized returns within a trading day, there is no major sector that is looking overbought. Jack joins us now for more. Jack, good morning. Good to see you.
Good morning.
Let's get to it then. Is this the calm after the storm or the calm before the storm?
Might be the eye of the hurricane, actually.
Is that what it feels like?
You can talk to me again in 2 hours, to be honest. And I can give you the base case and the bear case, realistically. But realistically, I think what we started seeing 2 weeks ago, 3 weeks ago, was a framing of what might absolute really bad look like and what might a path towards normalcy look like. And I think markets are trying to grasp around this idea of what might we hear consistently And that actually gives you room for which to actually think about, with a consistent strategy, with the tactics to get you to that. Then we can actually start framing what is the right multiple to pay for an earnings story, with understanding that the earnings story is going to be kind of messy in its own right. We're early enough into earnings season that we should stop calling it earnings season, because for the most part we knew the economy was okay, and it really hangs on guidance. And I think companies are even more grasping for what they might think about that operating environment looks like.
So that guidance, really helpful right now. Basically, we have no idea how to quantify this, or you can drive a truck through the estimates of the range of outcomes as we saw at United. What are we pricing in right now? And how do we get some sort of clarity on whether it's tariff uncertainty or whether it's potentially some sort of economic downturn?
Certainly economic surprises have been materially weak over the last 6 to 8 weeks. So that certainly suggests that there should be some some slowing in the aggregate. We've taken our earnings estimates down from a low double-digit rate of pace. Last time I was here a month ago, you tried pinning me down on the number. It now looks something closer to 5 or 6% in terms of still earnings growth going forward. Companies are very good at managing A, expectations, and B, they'll probably manage their costs well. Unfortunately, the more they manage their costs, the more likely we're going to see unemployment creep higher. You're going to see some postponing of capital spending, and that will raise some questions about what that growth outlook in the aggregate starts to look like. But again, tell me what the rules are, and then companies will figure out what they should be doing. Talking about, the H2O chip, that was engineered for that was a chip engineered to comply with trade restrictions in place by the prior administration, new terms of trade, and now we wind up having to re-engineer the business.
Based on the fact that we don't know what policy is and we're not sure exactly what the parameters or goals are, does big tech become uninvestable?
I don't think it's uninvestable, but it certainly has proved to be less of an automatic ownership position than it's been over probably the last 14 years. And I do think that speaks to, you can find interesting U.S. businesses that should be able to grow here. We're talking about the ongoing debate between the Magnificent Seven and the not quite forgotten 493. But the not quite forgotten 493 are a little bit more domestically oriented. They are probably less subject to some retribution when one thinks about, how do I start putting some pressure on trying to get corporate executives to try to lobby for a more consistent communication path, a more consistent policy path on a look-forward basis. And they're generally a little bit more domestic. When you start thinking about, where your patents, where your intellectual property is headquartered, and where that might be subject to pressure.
The Treasury Secretary says that the financial community should take a constructive view and look at the 3 legs of the Trump policy stool when it comes to tax cuts, deregulation, and tariffs. If you take their entire policy proposal together, do you have a more bullish view on potentially where the market's going?
I thought the 3 stools were 3% real GDP growth, 3% inflation, and 3 million incremental barrels of oil a day. So a nice reminder, perhaps, that we keep changing the terms under which we be judged. I wish when I was a student I could readjust what I was being tested on after I wrote the essay, but, I lived in a different world.
That was just one policy proposal that the Treasury Secretary was offering up. But Trump ran on 3 proposals, which is tariffs, tax cuts, and deregulation.
Yep.
So when you start seeing maybe the end of the year, tax cuts and at minimum extension of TCJA, does that give you some comfort when you see back and forth whirlwind of trade headlines?
I think there is a narrative that is quietly spoken in the market that the first month and a half have been designed to satisfy the base, and that the second half will be designed to satisfy the donor. That would be an interesting pivot in terms of what winds up coming through. That would look like deregulation. That would look like structural tax reform, but some parts of tax reform are sounding like tax increases, depending on where you wind up sitting in terms of what we wind up going through. Taking away things like the deductibility of local interest expense for companies at the same time you're telling companies to build large plants. So you wind up having some interesting puts and takes that can make for some interesting and, dare I say, confusing headlines. And I think, right now it's probably good to be a lobbyist in terms of being able to run up your billable hours and still be deductible.
It's certainly difficult to be an investor, let's put it that way. The sequencing is different to what we expected, Lisa. It's different to what we saw in the first term of the Trump presidency. And it's not just that. They've started with trade, but the methodology and execution has confused a lot of people as well.
Especially if the end goal is to essentially bring the trade deficit to zero. what would that do in terms of undermining the dollar position in a global currency type of perspective? And that's something that we see on an ongoing basis and raises a question. Is a weaker dollar going to be a tailwind for companies that are exporting abroad, or is it not really going to matter? Because ultimately, the terms of trade are changing, and the appetite is also changing.
Jack Caffrey, it's good to see you, sir. Thanks for dropping by. Appreciate your time. Jack Caffrey there at JP Morgan Asset Management. The euro at the moment against the dollar, euro-dollar about 113.61, so more dollar weakness this morning and euro strength, to Lisa's point. The equity market recovering a touch. We were down by more than 1% a little bit earlier this morning. Lisa, we're now down by just 0.6%.
Yeah, people assessing just how much there is an off-ramp. I love the idea, as you guys were discussing, that China is saying, look, we would be flattered if President Trump would want to negotiate directly with us, but maybe it would be better if delegates from both sides could come together and in a calm voice figure out what it is that we want to do going forward. I just, that's the messaging coming out of
China wants to deal with one voice.
They do.
Jamie Dimon at JP Morgan basically said to the FT that he'd like to see one voice, and he named that voice. The Treasury Secretary, Scott Bessent.
Of course, and China has always wanted to deal with Treasury. They always felt like that was a way into dealing with any U.S. administration. The problem is you have a cast of rivals, as Terry Haynes of Pangea calls it, when it comes to the Trump administration. Scott Bessent, maybe the more constructive on trade, but the likes of Howard Lutnick and Peter Navarro are certainly want to have their voices heard when it comes to a place like China.
They've gone a bit quiet over the past few days, that's for sure. Equity futures on the S&P, negative by 0.7%, with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. China says that it's open to trade talks with the U.S., as you were discussing, but only after President Trump meets its requirements, like reining in remarks from his cabinet members. Sources tell us that other conditions include a more consistent U.S. position and a willingness to address China's concerns around sanctions and Taiwan. The White House is banning NVIDIA from selling its H20 chip in China, a clear sign that the administration will stay the course on limiting China's AI ambitions. The restrictions will require a license to export the chips for the indefinite future. NVIDIA warns it will likely report a $5.5 billion write-down tied to inventory and commitments. And a check on United shares this morning. They are higher by 6.4% in the pre-market. Took the unusual step of offering not one, but two possible earnings scenarios, saying its 2025 outlook remains achievable, but also warning that a recession could nearly halve its profit forecast. The split forecast in reaction to the uncertain macroeconomic backdrop. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny a little bit later, and more from United Airlines later as well. We'll catch up with Scott Kirby, the CEO, later on this morning in a few hours' time. Up next on the program, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. They need our money.
Up next on the program, some reporting on China's reaction. Dan Clifton of Strategas, a Baird company, joins us next. Live from New York this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is
indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Struggled to grind out a third day of gains in yesterday's session. We snapped that two-day winning streak on the S&P 500, and we continue to decline this morning. We're down by 0.75% on the S&P. Under surveillance this morning, pushing for China to come to the table.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
So here's the latest this morning. The team here at Bloomberg reporting that China is open to trade talks if the U.S. administration shows more respect and is willing to address its concerns on Taiwan. Bloomberg's Tyler Kendall joins us now for more. The ball is in China's court. Tyler, what is China telling us?
Yeah, hey, John, good morning. Well, this is really the first insight that we are getting into what could potentially bring down the temperature after weeks of escalation. A source familiar with the Chinese government's thinking tells Bloomberg News that the most important precondition for talks is that Chinese officials feel that they will be treated with respect during them. It appears that Beijing would like to start to see President Trump disavow comments from his cabinet members when they are critical of China, even as President Trump himself says that he has a good personal relationship with Chinese President Xi Jinping. Also importantly, we're learning that Beijing appears to want the U.S. to appoint a point person to lead these talks that can speak and act in President Trump's capacity, even as President Trump himself still contends that he is waiting for Xi to call him directly. And we should probably note that direct calls to the White House have actually helped to expedite negotiations in some cases, such as after President Trump himself had talks with his counterparts in Japan, South Korea, and Vietnam. And Xi is also currently on a tour of Southeast Asia, where he's engaging directly with leaders in a bid to shore up support with them. Now, Bloomberg Economics estimates that once these talks do restart in earnest, they will likely take months and probably take us into 2026 because, John, it is an understatement to say that there is a lot to tackle here. But with tariff levels at record highs, we're now really starting to see the escalation point to those non-tariff barriers, such as a tightening of export controls. As you mentioned earlier on the program, of course, NVIDIA announcing that the U.S. has tightened restrictions on the exports of one of its more toned down chips, scaled back chips to China, and China really appears to be trying to restrict market access for U.S. firms, such as yesterday announcing the suspension of those Boeing deliveries.
Tyler, when it comes to this report, according to the person familiar with Beijing's thinking, the most important precondition is that Chinese officials need to know such engagements will be conducted with respect. They want the president to rein in some cabinet members that have disparaging remarks about Beijing. Who do you think China's thinking of?
Well, as our report indicates, China issued a rare rebuke after some recent comments from Vice President J.D. Vance when he was talking about how the U.S. is engaging when it comes to manufacturing in China, and that does appear to have sort of set off alarm bells when it does come to Beijing. We have to keep in mind here that this administration, so far, most officials really have been trying to engage with China. When we do see President Trump saying that he does have this strong relationship with Xi Jinping and that he wants him to call them. But important to note that we do know that negotiations had actually started months ago, particularly back in February when China was first slapped with that 20% tariff across the board. But it appears that they couldn't get over that initial negotiation when it came to fentanyl concerns. And since then, the gap between the two countries has only widened.
Tyler, appreciate the update. Tyler Kendall there down in Washington, D.C. To extend the conversation, Dan Clifton of Strategas, a bad company. Dan, welcome back to the program. The U.S. and China came to an agreement in the president's first term. How much harder will it be to come to an agreement in the president's second term?
Well, that took 20 months to get to that agreement, and that agreement was reached in January of 2020. We obviously had COVID after that, but the Chinese did not follow through on their commitments that they made to the United States, and I think that's still a sticking point here. So when I look at what's happening with U.S.-China talks, I think it's important for investors to see directionally if there's some sort of negotiation opening up. But I don't think that that's going to be the first one. In fact, I think that might wind up being the last one. And much of the negotiations I think the Treasury Secretary and the U.S. Trade Representative want to do is start to line up U.S. allies and start to ask those U.S. allies to be tougher on China, whether that's going to be in Japan or Vietnam or many of these other Asian countries. And I'm just much more looking forward to progress with U.S. allies on some of these trade issues and looking for progress on the tax bill before we see any meaningful progress on the China trade agreements.
When it comes to a Chinese trade agreement, though, what's on the table this time around that wasn't there in Trump's first administration? We've heard the president talk about things like TikTok. What else can possibly go into this negotiation?
Yeah, well, TikTok is one of them. I think there's going to be some non-trade issues around these discussions that would even extend beyond that. But when you look at it in terms of what the U.S. is looking for China, they're really trying to clamp down on those non-trade barriers. The stealing of intellectual property is still a major issue that's out there. They're probably looking for some direct purchases. I think that's going to be true for most countries, whether that's agriculture or liquefied natural gas. These are going to be big issues, auto access. So, you know, when you pull it all together, it's going to be a combination of tariffs, non-tariffs, and purchasing of U.S. goods. And then you can throw in all that fun stuff like TikTok and see if you can get some sort of deal there. I do believe that the president has geopolitical issues that he would like to wrap in with China as well. That is clamping down on Putin and seeing if there could be resolution on the Ukraine war, areas such as Iran and North Korea. So I think everything's on the table once you get into these trade talks. It's not just about trade policy.
Dan, you mentioned Japan. The president is awake and already posting on social media. This is what he has to say. Japan is coming in today to negotiate tariffs, the cost of military support and trade fairness. I would attend the meeting along with Treasury and Commerce secretaries. Hopefully something can be worked out, which is good, great for Japan and the United States. Dan, who's at the front of the line when it comes to negotiations?
Well, I think Japan and Vietnam are at the front of that line. You can also say that South Korea and maybe even India, to a lesser extent, are probably in that line. But look at what Japan is doing. They're talking about reviewing the U.S. Trade Representative's report. They're looking at all the non-trade barriers. Can we change the safety rules on autos to allow more U.S. cars to come in? Extremely constructive, very different than what you're seeing from Europe, which is like, hey, we'll buy your liquefied natural gas, which is probably not going to be enough. And that's why there's less optimism about some sort of deal with Europe on trade, particularly in the short run. So I think that the Japan talks are in good faith negotiations. What the president is saying there is really important. The president's saying that he may not provide military support for countries that the U.S. historically has done if they're not willing to negotiate on trade. He's using all the leverage points that he has to build a coalition, to build a better trade system in his mind, and stopping at really nothing, things that were not talked about in previous administrations before.
What can partners like Japan do to also make sure that they are isolating China, something that this administration seems to also want to be an end goal and part of the discussions when it comes to trade deals?
Yeah, awesome question. So, you know, when you look at it, Japan had a 24% rate in the president's April 2nd report. You got a 10% tariff on them. You need about 14% to gap the difference for the trade deficit if you're going to go off that math. So obviously the first things that are going to be on there is more involvement in the U.S. That requires about $20 billion of spending from Japan, or about 0.5% of their GDP on U.S. goods. That's a hard deal to reach alone. And then it gets to the heart of your question, what are you going to do for Japan? And what the U.S. is concerned about, particularly in the Asian countries, is that these goods are coming from China through Japan and then into the United States. So they want to limit that. What the Treasury Secretary has been talking about, and this is why China's got to be careful looking at it for him to be the point person, is that he's been talking about these countries putting tariffs on China just like the U.S. is. He had those conversations with Mexico, and I believe that he'll probably have those conversations with the Asian countries as well, and really start to isolate out China and start to build sort of this kind of coalition of allies that creates a more kind of modern trading system that leaves China out if they're going to continue to break the rules.
Dan, how realistic is this? This has been the nightmare for the Vietnams, the Malaysias, the Philippines, as well as Latin American countries, that they would have to choose between the U.S. and China. We saw Xi Jinping head over to Malaysia in the past few days. Is it feasible, especially for those so close geographically to China, to be forced to choose between the two major economies of this world?
Yeah, it's very tough. I mean, when you look at Vietnam, it's about 14% of their GDP, the U.S. tariffs, like in 1 year. That's like an amazing amount of of austerity that's being placed on them. And so some of these countries take it very personal, like you don't want us to have any type of economic growth. And you got to work through those issues overall. So in a way, I don't think that many of the exact goals that were put out by the administration are going to be reached. But I think if they move there directionally, you'll start to see it. If what choice do they have? If they don't make an agreement with the United States, those factories are going to close in Vietnam and they're going to go to Mexico. And I think it's very interesting that Mexico was left out of the universal tariff and all the April 2nd items after initially taking the brunt of Trump's sledgehammer at the start of this administration. Feels like Trump is trying to bring those supply chains closer to the United States for national security purposes, and that's why they don't really have an option. They're going to have to figure that out if they want access to the U.S. consumer, and if not, then you'll see a break. But I just don't think that there's enough Chinese demand for those countries to be able to replace the lost U.S. demand.
Hey, Dan, appreciate the update. Dan Clifton there of Strategas, a Baird company. Thank you, sir. The latest update then from the president, Lisa. Japan is coming to the table today to negotiate tariffs, the cost of military support, and what the president called trade fairness.
Yeah, and we knew that Treasury Secretary Scott Bessent was going to be meeting with them. First mover advantage. What kind of advantage do they get at a time where there are a lot of potential contentious issues on the table?
We'll come back to this story in just a moment. Up next, we'll catch up with Erica Najarian of UBS on a big quarter for the big banks from New York City. You're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function. It's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets,
Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Chip makers went on stocks this morning. Equities recovering. We're still lower by 0.75% on the S&P. We were down by 1.6%, recovering on the prospect of China coming to the table for talks with the United States. We'll get to that story in just a moment. With 3 hours until the opening bell, let's get to your morning movers with Danny Berger. Hey, Danny.
Hey, John. I just wanted to give you a look at what some of those individual chip makers are behaving like this morning. NVIDIA down 5.7%, again in the eye of the storm. Its H20 chip, specifically developed for China, being targeted now with export restrictions and a needed license. NVIDIA saying that that could cost them a $5.5 billion charge. It's not just NVIDIA, though. To your point, John, it is chip makers across the board. AMD really getting hit this morning, too, in the pre-market session. Down even more, 6.5%. The problem for them might not just be the export restrictions. It could also be the fact we had some pretty ugly earnings coming out of ASML in the Netherlands. They missed on their sales by about €1 billion. So you're seeing the entirety of the chip sector really hurting, considering they are also a crucial part of this supply chain. Finally, just wrapping things out with United trading to the upside this morning. Earnings yesterday, two very different forecasts. Perhaps this is the new playbook with uncertainty, saying here's our worst case scenario. Their worst case scenario, by the way, was about $7 per share. Their normal case scenario was on the high end, 13.5. So about halving if you do get a recession. Those shares up 6.5%, John.
More from Scott Kirby a little bit later, if we can get our microphones up. There we go. All right. Scott Kirby coming up a little bit later at 8:15 Eastern Time. On our radar this morning, China's saying it's open to trade talks if the US meets certain conditions. Sources telling us here at Bloomberg, China wants to see the Trump administration show more respect and a willingness to address concerns around Taiwan.
This is the first time we've really heard China respond in this great Bloomberg scoop, after you've heard from the White House yesterday saying the ball's in China's court. Some of the things they want is respect, reining in some of the rhetoric from cabinet ministers, a more consistent U.S. position. And then most importantly, Jonathan, and something you really touched upon, what Beijing is looking for is actually what Wall Street is looking for. Jamie Dimon yesterday was talking about the fact that there needs to be a point person, and Wall Street seems to be looking at the Treasury Secretary Scott Bessent to maybe take that lead driving seat.
In the meantime, both sides are clearly trying to create a sense of leverage heading into these negotiations. President Trump saying they want our money, the U.S. consumer and access therein is the most important thing. China saying, you want your rare earth minerals? Well, guess who has them? Your rare earth metals. And so this is really an interesting tit for tat as they both try to get position ahead of these negotiations.
Everybody's trying to position for leverage. Can the United States get their allies to put up trade barriers on China, which is where they have been consistent on this issue now for a number of months? Can they actually achieve that?
It is hard to see how a country like Vietnam, Malaysia, or the Philippines can make an enemy of China at a time when they have disproportionately benefited from some of the tariffs and the bans on what we've seen with the U.S. putting on China. They've been the connector countries, and suddenly they'll have to abandon those industries.
I asked the secretary about this, Scott Bessent, earlier in the week, and he said what China is doing is like that Fantasia Disney movie with the brooms and the buckets. Even if the U.S. tariff wall goes up, they're still going to be manufacturing, and they need to find a place to dump. So just by nature of what is going on, these countries are going to want to get on board so that they can also start blocking out some of the Chinese dumping that is going to happen.
Danny mentioned the chip makers, some of the movers in the pre-market going into the opening bell. Let's talk about them. Chip makers very much under pressure this morning. The White House slapping trade restrictions on NVIDIA, barring the company from selling its H20 chip in China. This coming as ASML reported lower than expected orders in the first quarter, citing tariff uncertainty.
It's difficult for these companies to know how to plan for the future when the future keeps changing. The H20 chip was designed for China with compliance from the previous constraints that the Trump administration had put on. ASML said it doesn't even know how to quantify the impact from the new tariff regime. This becomes very difficult for these companies to plan out, and frankly, it becomes very costly for them to try to adjust in real time. Again, macroeconomic paralysis.
United Airlines, a fantastic example of that. Love that, Jim Zelter.
Yes.
Fantastic phrase. United Airlines coming out with this, not one but two possible earnings scenarios. The company saying its 2025 outlook remains achievable, but also warning that a recession could nearly half its profit forecast. You've now got the C-suite, Lisa, offering a base case and a bear case. That's how difficult things are. They're flying with very, very limited visibility.
What's interesting is, first of all, they have no better visibility than we do at flying. I like the pun. That was very well done, by the way. Yeah, thank you. The other thing that I want to note is that United actually had a pretty strong outlook, just more generally. Consumers are still strong. How do you pair the reality on the ground, which is a lot of strength, with a lot of the negative prognostications at a time where there really is just a cloudy forest that we're walking into? And that is the difficulty right now for these companies, and right now that is the difficulty that a lot of investors have.
Two things I took away from that. One, their bear case is actually not so terrible. And also, as you saw Mohamed El-Arian on Twitter coming out, talking about this illustrates the uncertainty felt by quite a number of companies, that at some point you need to think about, well, we can either be in this fantastic area or there's a recession and we're gonna have to deal with that. And they're actually starting to put more people at work, like you said, Jonathan, becoming Wall Street analysts. They are just craving, they're so thirsty from certainty in Washington, D.C., and I hate to say this to them, you're not going to get it anytime soon.
We're not going to get now, that's for sure. Equity futures on the S&P negative here by 0.8%. On Wall Street, projecting confidence. Bank of America, JP Morgan, Citi, seeing a boost in consumer spending. Citi CEO James Fraser saying this, looking past the current uncertainty and saying, when all is said and done and long-standing trade imbalances and other structural shifts are behind us, the US will still be the world's leading economy. Joining us now to discuss, Erica Najarian of UBS. Erica, welcome back to the program. As we wrap up earnings season for the big banks on Wall Street, we've been talking about this over the last several days. They've projected confidence, raising the guidance at JP Morgan, coming out with a buyback of up to $40 billion at Goldman Sachs. What underpins, Erica, that confidence?
Look, I mean, at the end of the day, they're making a lot of money. You know, capital markets may be at a pause, to paraphrase Lisa. It's hard to plan for the future when you don't know what the future holds. But, you know, trading, like I said last week, was lights out. Growth wasn't bad, even on the commercial side. And, you know, actually, I would say that card growth actually slowed a little bit, but it wasn't as dire as everybody had feared coming in. So at the end of the day, if you're thinking about all that volume and a decent level of interest rates to multiply that by, it's not a bad showing. And speaking of, you know, the ability to buy back stock, you know, the stocks essentially started pricing in a recession back in March. And with all this capital that's been produced, you know, by strong earnings, the banks are saying, look, you know, we're willing to buy back our stock cheaply.
One thing that we heard from the Bank of America chief financial officer as he came out, he said, we've got a healthy pipeline and our clients are simply waiting on more clarity on trade policy and the regulatory environment before committing to deals. Also, employment proving to be resilient. And to your point, Erica, the consumer hanging in there, maybe pulling back a little on cards, but still paying their bills. Erica, are banks still a leading indicator for economic prosperity or economic trajectory ahead? Or are they kind of something in their own bubble based on their selectivity in terms of their customers as well as their fortress balance sheets?
Yeah, that's a great question. So I would say they're a little bit of both. They're a leading indicator, I think, because of the activity levels. So I think it's, you know, what's interesting to point out, Lisa, the pipeline is actually even stronger than it was last quarter. So when you hear Bank of America or Goldman or JP, the pipeline for new deals is actually stronger than even ending the fourth quarter when we were so hopped up on animal spirits. And so if we actually understand the rules of tariff land, we actually could have even better activity levels. And if the stock market starts reflecting that, that could actually perhaps reboost consumer confidence, who knows? But to your point, I really like that point you brought up, because of sort of, you know, the decade-long transformation that was really driven by, you know, a generational change in regulation and zero interest rates. You really took a lot of risk out of the banking system. And while, you know, card risk is pretty much the same at this time as it was, let's say, 10, 15, 20 years ago, a lot of corporate credit risk is now, you know, really diffused outside of the banking system. So banks may not be necessarily a leading indicator of commercial real estate or commercial pain any longer.
Heading into this earnings season, one of the big questions was just credit quality, whether there still would be the activity that people had expected. I'm wondering if we're asking the right question, if it's really looking for weakness or whether it's recognizing the ongoing strength, despite some of the uncertainty, at least at the headline level.
So it's hard to know what question to ask, right? Because, on one hand, you're looking at, pretty decent activity levels still, that's driving pretty good revenue growth. And then you're looking at the inventory of future credit problems, and they're just not there. But then you're looking at a market that's really concerned about what tariff policy is going to do to the U.S. economy. And all the banks can really do is play defense, right? Defense with their capital. And what you saw this quarter is banks really build their rainy day credit reserve and say, hey, we don't know what's going to happen. The inventory of future losses really isn't quite there yet. But we know you're worried. So we're going to move capital from one part of the balance sheet to another in our loan loss reserve and save for a rainy day.
Erica, who's best positioned when it comes to the banks, when it comes to policy uncertainty?
I hate to give you the boring answer, but really, JP Morgan, I think at the end of the day, they just have best-in-class capital. They have a diverse set of businesses that they're, particularly, top in, and they're not particularly reliant on, international, or revenues. And so, again, I hate to be boring, but I really like how JP Morgan is positioned here. I think probably I would say an underrated answer would be Bank of America. Bank of America has a lot of strength underneath the surface. They tend to be very domestically focused. And by the way, the knock on that stock is that they haven't taken as much risk as Jamie Dimon has. And if you're really worried about the trajectory of the U.S. economy, that stock hasn't acted as defensively as it should. And so I think the underrated, best positioned bank out there is actually B of A.
Erica, before you go, can we just finish on JP Morgan and Jamie Dimon and that interview with the Financial Times? I don't think it's been talked about enough. That's the first time that I've seen Jamie Dimon really entertain life after JP Morgan. He says at the end of the interview, in the quote in the print edition of the story, that he could be a competitor or an aide to the FT. It's something I think all the papers should be doing, but I'm not going to tell you what it is right now. Erica, how close are we to Jamie Dimon stepping aside?
So he did tell us he still has a couple of years yet. And so, personally, I'm watching every time I, commute in from the Upper East Side. I watch how far the building, how much progress we have in terms of the new building over at 270 Park to see. I think he's going to cut the ribbon, but he does have a world-class bench. So I'm not sure, investors are all that worried. But I think we have a couple of years left. But I think that's a good observation because it's clearly, the biggest and most watched succession story in financial services.
We're certainly getting closer. Erica, appreciate your time as always. Erica Najarian of UBS. I think we're all doing the same thing. It's been busy in that part of Park Avenue for a number of years now. This line here, there's a little media thing I may do when I'm done with this job.
There is a sense that he's been planning for it. He said vocally that succession planning is the most important job for him right now, which is the reason why there has been this rearrangement and sort of a beauty contest at some of the top officials at JP Morgan. Teasing a little bit more, is he going to run a new publication, The Diamond Daily?
I've got no idea. There's a great name for it, though. We'll see.
Okay.
Equity futures on the S&P. We're negative by 0.75% with an update on stories elsewhere. With your Bloomberg Brief, it's Danny Berger. Hey, Danny.
Hey, John. President Trump said that he will attend a meeting with Japan to discuss tariffs, military support, and trade fairness today. In a post on Truth Social, Trump said that U.S. Treasury and Commerce secretaries will also be in attendance. Japan is one of the first countries to negotiate the levies. Elsewhere, Russia has asked the U.S. to let it buy Boeing planes using money from billions of dollars in frozen state assets. Sources tell us that Russia understands the frozen funds can't be used until a Ukraine ceasefire deal is reached. The deal could form part of sanctions relief if and when there's a ceasefire. Meta CEO Mark Zuckerberg taking the stand for a second day in the FTC's antitrust trial, saying in 2018 he considered spinning off Instagram over concerns that it was overshadowing Facebook. He also acknowledged that he thought Meta would be broken up over the next 5 to 10 years and considered strategies to avoid such an outcome. He's expected to testify again today. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. Up next on the program, airlines navigating with limited visibility.
The effect of the current trade negotiations is here. In inbound travel to the United States, certainly there are things in the air, right? There's the fear of inflation, recession even.
Up next on the program, we'll catch up with George Ferguson of Bloomberg Intelligence, live from New York City. You're watching Bloomberg TV.
Incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities negative here. We're down 0.75% on the S&P. Chip stocks weighing on the equity market worldwide. On the Nasdaq, some underperformance. We're down by 1.4%. In the bond market, some pretty good news for you. Yield's still lower. We're down about 3 basis points at the front end of the curve. We're stable on a 10-year maturity, 432.91. Two things to look for a little bit later. 8:30 Eastern time, we'll get U.S. retail sales, the consumer very much in focus. Then 5 hours later, 1:30 Eastern time, speaking to the Economic Club of Chicago, the Fed Chair, Jay Powell.
What's he going to say, given the fact that there's so much focus on bond market dysfunction that's going to force the Fed to step in? Is he going to reiterate what Chris Waller said, which was essentially that they will think about cutting rates in the face of real weakness? And then how much weakness do they need to see? Because right now, at least in the earnings, we're not seeing dramatic weakness that looks like it's going to show up anytime soon.
I'll do what United Airlines does.
Please do.
I'll give him 2 options. He can do a Governor Waller or a President Kashkari.
Ooh.
Pick your poison right now.
There's no way he's going to do either of those. Those are the two polar extremes. That's basically saying
Something
earnings
in
are
the
going to go to 0 or earnings going to go to 1 million.
The chairman's prioritising coming in, I think, for optics and communication purposes, pledging to anchor inflation expectations. That seems to be the focus. I'd be surprised if that changed in this address.
I would agree, and part of the reason why is game theory. It's this idea that if they signal that they are going to cut rates, then the market's going to move and make it more difficult for them to actually achieve that inflation expectation stability that they're looking for. So don't expect fireworks, don't expect anything that's particularly market moving. And right now, it really is about watching the earnings and understanding when the soft data will start to trickle into the hard data, or whether this will be a divergence for the ages that will get looked back on as a big ultimate head fake.
Just how are we going to close that gap in the coming months is a huge question. Under surveillance this morning, let's talk about the airlines. Airlines navigating with limited visibility. So here's the latest. United Airlines shares are up after the firm took the very unusual step of offering two possible earnings scenarios. Bloomberg opinion columnist Mohammed Al-Arian posting on social media, the United's move highlights why it's important to think in terms of multiple scenarios for internal planning and not just stick to the usual in this macro environment. Joining us now to discuss is Bloomberg's George Ferguson. George, welcome to the program again. Let's talk about this very unusual approach. Why do you think they came about with this?
Yeah, I think it is because of the unusual times. I mean, if you listen closely to the Delta earnings, the Delta management talked about all the things they were worried about, but most of them were not yet manifesting themselves. And so I think we're going to hear more of that today from United. We're going to hear about worries from tariffs. We're going to hear about worries from the stock market swoon and what it's doing to their consumer. But my guess is they're not seeing a lot of of the effect yet, and maybe even concerned or cognizant of the fact that this tariff negotiation may not go on for a full year, may go on for a couple months. And so I think it's stretching their ability to give visibility on the profit outlook for their companies. And so in this case, I think they've gone to two scenarios.
How different is the outlook for United, for Delta, even for American versus the Southwests of the world or the JetBlues of the world? How much can some of the largest players really exercise their heft and their resilient balance sheets to gain market share in a time of uncertainty?
I mean, in a time of uncertainty or a downturn, you always turn to the best balance sheets, right? They always give you the most distance, I guess, to the door or to significant problems. And in the U.S., that's Southwest, that's Delta. But look, I think that going into a potential downturn here, my guess is that you're going to see the higher end consumer hold up better, and that's really what's been helping United, American, Delta outperform. And so I think that puts them in better stead going into it. Again, a downturn that probably going to affect the lower end consumer more.
There's a question about pricing as well, implicit in both Delta and United saying that they plan to cut capacity later in the year. How much are they planning to get ahead of any decline in demand and essentially reduce supply to keep pricing where it is?
I mean, it takes time, right? And so I think that's why you saw United say they were going to start to cut in 3Q. But Delta went a bit further, and they said they were going to flatten growth, right? No growth for the back half of the year. So Delta a bit more aggressive. I think Delta, one of the challenges there is they're more of an Airbus shop, and so they've got to be, they bring more of their fleet is Airbus focused, and so they'll be, they don't want to really bring airplanes in right now. They set it outright and pay tariffs on it. So Delta may have a bit of a disadvantage and therefore may not be able to bring in the capacity they want. Now, we've been watching fares. We watch yields, which is price paid per mile flown. And what we've seen is they've been edging over, even since the end of last year. So we're not surprised, I think, that pricing here, it looked a little softer to us. It's better at the big full service carriers. So as we get into low cost, we'll see even more what it's doing to the low end consumer. But it was soft again before tariffs. So we do think capacity has to come out of the marketplace to firm up pricing.
George, you just mentioned Airbus. Are they sent to win in this tit for tat when it comes to Beijing and Washington, based off the news that China is now halting deliveries or their airlines to continue ordering Boeing jets?
So I don't think so, right? And so we have a report that's going to come out in a couple of days. I've been watching it closely, right? And so there's a couple of things. One, I would say the Chinese announcement that they're not going to take any more Boeing airplanes is more headline than anything, right? So when we look at orders from Chinese airlines for Boeing aircraft, there's some 240 or so orders on Boeing's books. Only 16 of those orders have been placed this decade. The majority were placed in 2018 or previous. The Chinese really have sort of put Boeing in the penalty box for a while and not placed orders. So I think that's, they've just finally admitted that. And, one of the things we look at is we look at the tariff, issue. One, I would say Airbus has a lot more customers in the U.S. than Boeing has in Europe. Boeing has a core Ryanair customer in Europe. That's their most important customer there. In the U.S., Airbus has Delta, Airbus has Frontier, Airbus has Spirit, Airbus has JetBlue. Those are all core customers. And so when we added up the number of aircraft in fleets and the number of aircraft on order, it's very even in the U.S., Airbus and Boeing, and it's tilted for sure to Airbus in Europe. And the other thing we're thinking about right now is, as the administration gets into some of these negotiations with trading partners around the world and asks them to equalize their trade, one of the things that probably is going to be on the table is going to be buying more Boeing aircraft. And so Boeing lagged last year in book-to-bill and the number of orders they took in. As they start to build more airplanes this year and confidence is restored in the company, I think you could see some Boeing sales, on the back of some of this tariff discussion.
You touched on the major issue. They've got to build them. George, appreciate it. George Ferguson there of Bloomberg Intelligence. George, thank you. Let's wrap up earnings season so far. The financials have projected confidence, and United Airlines just not as bad as people thought it would be based on the guidance some of these airlines gave us a few weeks ago.
To me, the big story is that a lot of these companies, to the extent that they've got visibility, it's pretty darn good. And they're looking at a potential outlook that shows a resilient consumer at a time where people are worried about a downdraft. More than half of S&P companies that have reported earnings in the past month have maintained guidance. The rest of the half is split between raises and cuts. So it's not this Armageddon, at least in earnings.
I don't know where we're going, but starting points matter. And the starting point for corporate America is pretty decent based on what they're telling us. Coming up next on the program, we'll catch up with Alicia Levine of BNY Wealth. We'll speak to Bloomberg's Tyler Kendall, the former House Majority Leader, Eric Cantor, and Alan Ratner of Zelman & Associates. From New York, the second hour of Bloomberg Surveillance is up next.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
In the near term, I think the risks are still elevated.
It is the calm before the storm.
We have been seeing this weakening in the economy, a very gradual weakening.
The soft data is telling you that the hard data is likely to weaken.
What we are actually going to see is probably slow deterioration in the growth trend.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, with equity futures on the S&P negative by 0.75%. Chip stocks weighing on this equity market. We'll get to that story later. On the Nasdaq, some underperformance, down by 1.4%. Speaking of the story we'll get to later, 8:30 Eastern Time, 90 minutes away, U.S. retail sales. We know how the consumer feels. It ain't great. What have they been doing? Retail sales drop later on this morning, and then after that, you'll hear from the chairman of the Federal Reserve, Chairman Powell, at 1:30 Eastern Time, the chairman on the U.S. economy.
And how much is he going to reiterate the sense that they are going to address weakness in the economy? The bigger question is, will they see weakness in the economy anytime soon? Bob Elliott at Unlimited Funds put this out on X that I thought was really interesting. The soft data can't get much worse, so its impact on markets is limited. It seems it'll require weakening hard data to convince the markets that growth is on a path to decelerate meaningfully. People are still waiting for that Fed put. The question is whether the data will work in their favor.
In the last few weeks, Lisa, as you know, we've had a loss of confidence in U.S. policy. To repair that, we need to see some evidence that negotiations are happening and that they're fruitful. This is what we heard from the president earlier on this morning. Japan is coming in today to negotiate tariffs, the cost of military support and trade fairness. I will attend the meeting along with Treasury and Commerce secretaries.
Well, this really just reiterates what Secretary Bessent had said to me about trade negotiations, was that is going to start from the top, and any negotiation the president is going to sign off on. Now, Donald Trump is taking it in even another step. He's going to be entering a meeting with individuals below him. These are trade negotiation teams, but he wants to be in the meeting. So you see the direction of travel when it comes to a process that's taking place when it comes to trying to get these deals. At the same time, you see headlines drop that Governor Newsom is going to sue over what this administration is doing with tariffs. A lot of tension now brewing when it comes to trade.
That headline just crossed in a Bloomberg terminal. I'll share that with you again. The California governor, Gavin Newsom, saying the state will sue over Trump's tariffs.
And we were expecting some sort of lawsuit, particularly from Gavin Newsom. A real question here going forward about how much some of these tariffs are going to get caught up in the court system, given the fact that people are questioning the IEEPA statute, how much this has to do with national security, and just how much power the president can take. This, again, prolongs the uncertainty because what will actually get done in the court system will take some time.
Very different what you're hearing from Governor Newsom, who's talking about the three major export hubs being Mexico, Canada, and China, as it's going to impact their economy. Then when you heard yesterday around the table when you guys sat around with Governor Youngkin, we can deal with this and we need to reset trade imbalances. Depending on the governor, I think it really depends on if you're from red state or blue state.
It's pretty tiresome to deal with right now, let's put it that way. I'm sure you all feel the same way. Equity futures on the S&P 500, negative at the moment by 0.8%. Coming up this hour, we'll catch up with Alicia Levine of BNY Wealth on China coming to the table, the former House Majority Leader Eric Cantor as Wall Street looks for policy stability, and Alan Ratner of Zelman & Associates on the state of the housing market. We begin this hour with stocks recovering on signs China might be willing to engage in trade talks. Alicia Levine of BNY Wealth saying The administration's Let's Make a Deal show removes the worst-case tariff scenario. The market can only inflect higher with a policy response. There will be equity vol as long as there is policy uncertainty. Alicia joins us for more. Alicia, good morning.
Good morning.
There's certainly a lot of that going around.
Yeah.
Are we addressing any of this?
Look, I think, you know, as I've said, like, time is not on the market side and time is not on the real economy side. The longer this gets drawn out, you're doing real damage as corporations and individuals are sort of frozen in place, waiting for what the actual policy is. So the interesting thing about the 90-day pause and the recategorization of some of the electronic tariffs is that it does remove some of the left tail risk in the market, but it doesn't really remove the left tail risk in the real economy, which is getting damaged every day. So at first we were optimistic on that 90-day pause like everybody else, and then when you start thinking about what this actually means, it means it's going to go on for much longer. So Q1's going to come in fine. You had pre-buying before tariffs, and the hard data, as we've talked about, has held up fairly well. The soft data is rock bottom. And again, you know, where can this go from rock bottom, right? So you're there. In fact, we did a chart for our team about, you know, what happens when consumer sentiment hits rock bottom. Well, it turns out the S&P tends to rally right after that. And we went back about 40 years with this. So, you know, the soft data is not telling us anything that we don't know. But we're here, and you know, the concern really is that unless you start seeing the outlines of what a deal looks like with Japan, what the broad outlines, yes, details can take 6 months, 12 months, but what does it look like that would further remove left tail risk on the market? And I think here you're fairly priced. You're fairly priced at about 5,400 for where earnings are going.
8:30 Eastern Time, U.S. retail sales. U.S. retail sales for March. Is it too early to expect some weakness to show up in those figures?
Given the fact that the sentiment data was already cratering in March, if there's some read-through, you should start to see something going on. I find what's fascinating, actually, is the fact that tariff is on everybody's lips. The American public, which tends to tune out a lot of political stuff, is talking about tariffs everywhere. And so everybody knows about it and concerned about it. And of course, it's the inflationary piece that everybody's worried about because we just lived through bad inflation 2 years ago. And so that's the biggest fear here. But sales probably represent some pre-buying.
What do you need to see to try to get more confidence in some sort of risk rally? And I say this at a time where we do have a number of earnings that are coming out pretty positive. UBS's CIO came out with a list of 5 reasons why they actually are getting pretty positive for U.S. equities in a 6 to 12 month basis. And they include April tariff showers, May fiscal flowers. This is really fun. The Fed put and the data by U.S. exceptionalism, especially when it's on sale. That last point, do you think that the divergence between the U.S. and the rest of the world has been overplayed?
Totally. I think it's been totally overplayed. Meaning the rest of the world, we are the buyer for the rest of the world. We have, you know, the best consumer on earth. It's 70% of U.S. GDP. The consumer can be down, can take a break, but ultimately this is what drives the global economy. And if there's concern about where U.S. policy is going, well, boy, the rest of the world really has an issue here. That doesn't mean the rest of the world can't outperform this year in some sort of catch-up trade as some of the heat from the tech sector comes out on the multiples and the S&P resets here. That's perfectly reasonable. But if you look forward for the cycle where this is going, I struggle to accept the fact that the rest of the world will be growing faster than the U.S.
At the same time, people talk about the response to tariffs from the U.S. and it comes to fiscal spending. You've seen that in the U.S., you've seen that in Europe, you've seen that in Japan, you've seen that in China. Why can't you just follow the fiscal spending at a time when a lot of people are saying that tariffs will hurt the United States as much as some of these other trading partners?
So the fiscal spend is a great story as a trade. You know, in the end, we do long-term wealth creation, we do long-term wealth preservation. So that for us would represent, you know, a nice trade for the next 12 months. That's probably the right framework to look at it. But if you look at how the markets have performed since Liberation Day, actually the U.S. has outperformed the rest of the world with the understanding that the U.S. is actually in a better position here than the rest of the world, specifically on the trade issue.
So fiscal can only get you so far, as we've seen in the U.S. You can prop up the economy for a couple of years, and then you really have to deal with the underlying productivity and barriers to growth that you have, for instance, in Europe, that you have to deal with. So they're going to put $1 trillion into the economy. How productive will that capital be? Right? Where are the regulations going?
Trying to get some visibility on policy down in Washington, and now we've got legal issues. So if you're just joining us, I want to share this story with you again. The California Governor Gavin Newsom has said his state is suing to hold President Donald Trump's tariffs, citing harm to consumers and businesses. Harm to consumers and businesses. Now, this is something people have been talking about for a while. Is that enough to say you've got a legal footing to push forward and really stop what's happening here?
Well, I think given the fact that the United States, the administration has come out and said that this is due to IEEPA, a national security concern, that likely that will be upheld in court. And I think this is one of the things that Jamieson Greer, the USTR trade representative, has been very focused on, making sure that anything they come out with can legally be upheld in court. But the courts are going to fight it out, and certainly Governor Newsom, I think, eyeing maybe a 2028 bid, is going to do whatever he can to try to make this point very clear.
This is almost exactly what Libby Cantrell of PIMCO said to you and I on Sunday evening. This is what she was anticipating, these kind of things, and this is the first, and I'm sure it won't be the last.
And this is ultimately the real question with exemptions. How much does that open up the Trump administration to legal challenges based on the fact that, is it a national emergency or not? There has been a lack of direction in terms of exactly why some of the tariffs have gone on, which might go to some of the legal fight. That said, even if they do get undermined, there are other provisions that this president can use to try to get these tariffs through. So again, the whack-a-mole of tariffs, it's not going to go away. It's just going to get dragged out in a court system.
Alicia, everyone's become an expert in trade relations, and now they need to become an expert in trade law. As an investor, how do you navigate this mess at the moment?
Really difficult, really difficult. Look, I think with the VIX at 60 and the S&P hitting about 4,800, that's typically a signal to close your eyes and buy. Because your downside from 4,800 in the worst case scenario is probably a 4,400 or 45. Worst case scenario, like deep recession, earnings get cut to 230 or something like that. Is probably a 44 to 4,500 from 4,800, and it's asymmetric risk to the upside there, particularly when VIX hits 60. So we're looking at technical analysis for that kind of thing. The 200-week moving average on the S&P, which is held for about 50 years, is at 4,600. So 4,800, you've essentially de-risked it. The only time the S&P went below the 200-week moving average was during the depths of the global financial crisis. And then it popped right, and every crisis, you just hit it if it's bad enough, and you respond from there. So that's what we're looking at. Here at 5,400, again, where we think earnings are going, which, it'll come down over the street, you're probably fairly priced for now for the kinds of uncertainty, very difficult to model. I think it's really good to remember, though, there's also right tail risk. We all sit here and talk about the left tail risk. We can't model it. It's a terrible policy. It's inflationary. It's deflationary. We're going to go into a deep recession. But there's also the right tail. And I think in markets, there's always a two-way trade. And I think now you're starting to get the conversation about, okay, what could the upside look like? And I think